we may once again be surprised in the second quarter to see earnings being much stronger than maybe we might have thought.
You're going to see the economy move into a position of excess demand.
I think we have seen the peak in rates probably for this cycle. There could be another twin peak later on.
We think that the Fed is correct, right? That inflation is transitory.
If you do get this sort of sense from the Federal Reserve towards August, September, that they're looking towards tapering their asset purchases, a lot of traders are going to be caught off guard.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Back to 125 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Lisa back with us next week. Another week's vacation.
What's that about?
No idea. Kailey Leinz in the seat.
It's almost as much
She'll
vacation as
for the next
Kailey
couple
Leinz.
of days. Equity futures, Tom, down 26 to 42.93. 125 on 10s, Tom. Get your attention.
John, I got too many people telling me this Monday's boring. It is not. The markets are absolutely fascinating. I must have gone through 15 different series on the Bloomberg terminal. They scream global slowdown.
Had a little look at 124 earlier this morning. Tom took out the lows of a couple of Thursdays ago, back to where we were in February. Euro dollar with a 117 handle as well, Tom. It's not just the bond market, it's foreign exchange and some dollar strength in the mix.
It's all correlated in. I like what Kit Juke says. He really identifies at SocGen today support in the euro. I know we're going to get to that in a moment, John, but really so many of these are at resistance, at support, maybe a critical time to decide which way we go.
We'll catch up with Nomura a little bit later. Kailey, we've got to talk about the airline stocks as well. Yep. American Airlines is down more than 20% from the June highs, and travel in Europe this morning getting hammered.
Yeah, you have concerns about the Delta variant, and it's not just the airlines, John, the cruise lines as well, because you had a judge knocking down a ruling that was going to ease some of the COVID-related restrictions on cruises out of Florida. As a result, Carnival, Norwegian, Royal Caribbean, all some of the big underperformers in early hours this morning, John.
The President of the United States, Tom, a couple of days ago said several days. I think it was several days ago when we might find out what happens with travel. Is several days Monday? Is that today? Is it tomorrow?
I don't know what it is. I mean, between the infrastructure debate out there, but on COVID, really, John, I really felt a sea change in COVID. I have offspring in L.A., Los Angeles back to masks outside. I mean, this was an important weekend for this exhaustion of an 18-month pandemic.
We'll pick up on that in just a moment. Here's the price action to kick things off this Monday. Your trading week starts right now. Equity futures on the S&P, 42.93, down 26 with negative 0.6%. Into the bond market we go with a bid. Yields lower by 3 basis points to 125.85. We had a 124 handle a little bit earlier in the session. And in foreign exchange, Kailey, euro dollar 117.82. Kailey, we're down 0.2%.
Indeed we are, John. I want to also talk about what we're going to get later on today, because important data coming at 10 a.m. Eastern time. NAHB, the housing builder sentiment indicator. We're looking for a print of 82, but it fell to 81 last month, which was a 10-month low. Why? You have a rising cost, both in terms of labor for some of these builders, but also in supply, in the materials they need. Granted, lumber futures down in a big way from June, so we'll see if that sentiment reads through in the data today. Also coming up post-market, I'm watching an earnings story. It is a big week for earnings. IBM due after the bell. We're looking for any kind of sales growth, especially as the company is shifting more toward cloud computing. And I bet we're going to get some questions on the call as well about the leadership shakeup we have seen recently. Of course, Jim Whitehurst, the president who came to IBM via the Red Hat acquisition, is now gone. The first real shakeup under the new CEO, Arvind Krishna. So I'm betting he is going to need to answer for that on the call. Final thing we're watching today, really all day long, it is Freedom Day in the UK, but it may be not as happy as an occasion as some may thought it would have been after we saw 50,000 new cases on Saturday, 47,000 new COVID cases in the UK on Sunday. And now you have Sajid Javid, the health secretary, has COVID-19, has tested positive, and Boris Johnson himself is in isolation. So it's Freedom Day, but I'm not sure people in the UK are feeling all too happy today,
Yeah,
John.
I don't know how many are. Kailey Leinz, thank you very much. We've got to turn to the only man, Tom, the only man in the city of London who might get married in several days' time, but is still turning up on TV and radio and looking at foreign exchange. Tom, what do you make of that?
John, you know what's amazing about this is only Jordan Rochester would hedge his wedding.
In sterling.
You know, who would hedge their wedding?
Let's get to Jordan Rochester, Nomura G10 FX strategist. Jordan, congratulations. We'll talk about the wedding that's going to take place in several days' time. We'll do that in a moment. Let's start with this market. The dollar's back to where it was in March. That was the peak of the year for the US dollar. This is a very different kind of dollar strength, Jordan. Why is it different?
it's because it's pricing a global slowdown, John, and that's the tricky thing for me. I could really handle. In Q1, we had just Fed pricing. That was the Georgia runoffs. We saw the big move in US yields. And that's been our benchmark, the 117.04 level in Eurodollars, that resistance level we've been watching, and we're nearly there. But each time you test the resistance level, John, it gets weaker. That support level gets weaker. And when we get to the Q3, Q4 outlook, it's much harder than what it's been for the past 4 to 6 months. The reopening trade, we've reopened. So what's next? The next trade, unfortunately, for market pricing is the slowdown trade for several reasons. One, you've got credit impulses slowing down. The fiscal drag in the US next year will be massive. Same for the rest of Europe. We won't be spending the same much to avoid a pandemic shutdown. So that's the fiscal and the credit side. Then you've got consumers. We've seen the University of Michigan survey saying now is not a good time to buy a home, a car. We're seeing supply constraints, John. We're seeing folks not being able to go into work because of COVID cases, but also this semiconductor chip shortage that's closing down factories. And then you've got what's going on in China, first into COVID, first out. And they're telling us in their data, the PMIs and all of the sort of forward-looking indicators there, we're going to see a slowdown. John, slowdowns aren't good for other currencies. The dollar tends to do well in that environment.
Jordan, good morning. I'm absolutely fascinated by Michael Darda's note today that says the great distinction here from the taper tantrum of a number of years ago is this has been an adjustment in real rate expectations. I have an absolutely stunning 10-year U.S. real rate, negative 1.09. Folks, a negative 1.12 would be a record low. Jordan, how much is this about inflation-adjusted rates versus all the other mumbo-jumbo?
The mumbo-jumbo. Well, I like that, Tom. Well, in terms of the mumbo-jumbo, talking about growth rates, so the US doing really well versus Europe, those growth rate narratives don't actually work. What really works is the real rates of the US and nominal yield spreads versus those FX pairs. So right now, Eurodollar, for example, is trading 1-for-1 with where 2-year swap rates are versus the US and Europe. So that's stripping out the mumbo jumbo. If you have a view on 2-year rate spreads, you've got a view on FX. And the problem is no one expects the ECB to be raising rates anytime soon. So it's all US driven. It's all about Fed timing and where things can go there. And for the time being, we might have seen a maximum in Fed pricing in terms of we're now seeing Delta pick up as a risk in the US, and that might see people pare back their expectations for rate hikes next year. And that is going to constrain the dollar strength. But on the other hand, because euro yields can't really go up very much, they can only really go down if you get a slowdown taking place. And that is going to constrain Eurodollar from rising. So I'm struggling right now to say why Eurodollar should be a buy right here and now, despite all the balance of payments data, the charts I look at suggesting dollars a sell. And we're in this really painful macro environment where lacking positive catalysts to say why you should sell the dollar and buy high risk. Meanwhile, the US trade balance continues to widen, and therefore my sort of framework say I should sell the dollar. And that's why we're in this bit of mess right now. It's been very range-bound for the past couple of weeks.
Jordan, the one exception in G10 that is stronger against the dollar today is the Japanese yen. Horrid first half for the yen. July, though, the start of the third quarter, has actually been pretty solid. We're back below 110. What do you think the trajectory is going to look like from here?
Well, we're biased to say if you think US rates are going to rise, dollar yen should go higher. And so that sort of 110, 111, 112 sort of region should be where we start to head towards in Q4. However, right here, right now, in the very short term, we're in that frustration pain trade. So Q1, Q2, big dollar yen longs bought because of that move in US yields. They kind of hung in there during most of the summer so far, but I think now it's become a pain trade for dollar yen. So we're just seeing that short-term position squeeze drive this move lower. And also US yields have cooled off too, if you look at the 10-year, for example. So that's where we are right now. Short-term downside, but in the medium to long term, dollar yen's a buy.
Jordan, I had to put you on the spot. Just a final question on euro dollar. More chance of getting to 110 first before 130?
If the Greens don't have a good election in September and we start pricing in French election risks, if Marine Le Pen starts to poll better, at the moment she's pretty close to Macron in the second round polling. But imagine if she got over 50% in a poll. That's how we get down to that 110 level, I think. Wow. Or if we see the Delta wave lead to lockdowns in a similar sort of environment to what we saw in March, April, May of last year, that's what could get us there. those are all tail risks. Those are not my base case. I still think euro dollar is going to be a buy at some stage. We just need to see some reason for a positive catalyst to trigger that trade. But the sort of 120, 125 range is where I think we'll end the year. If we get the Greens, for example, do well in Germany, that could definitely drive it.
117.78. You get the final word, Jordan. You get the choice as well. You can give us a comment on the wedding this weekend or a comment on Jack Grealish potentially leaving your beloved Aston Villa. Where do you go? Take your pick.
Oh, Jack Grealish, what a legend.
There we go.
I really hope he doesn't leave.
That's all
but
you
the
need to know.
wedding's going to be there on Saturday.
You led with Jack Grealish, Jordan. You led with football. Jordan Rochester of Namora.
Shows you what's more important. There's no question about it.
Good luck after this interview as well, apparently.
Yes, good luck.
Tom, euro dollar 117.77. A breakdown here and a breakout for the US dollar. That gets your attention. I've talked about this a little bit earlier this morning. The bond market at 125, euro dollar at 117.77. Away from the equity market, let's be clear. What are we? 1-2% from all-time highs. The bond market is where the moves have been.
Yeah, it's a global slowdown field. John, you are bold to go out to a 110, getting Jordan Rochester in trouble there with big figure moves. What I see this morning, John, George Saravella's publishing moments ago at Deutsche Bank. Carl Weinberg will join us as well. Both of them, maybe a little bit nuanced, are looking for global slowdown. And to me, John, that's the Monday headline of these market moves.
Do you think the ECB on Thursday just got a little bit more interesting?
Way more interesting, yeah, absolutely.
Full coverage on Bloomberg TV and radio ahead of that ECB decision this Thursday. Might bring you the whole news conference as well with President
Don't cry.
Lagarde.
Jordan loves you.
42.85 on the S&P. We come in 0.8 of 1%.
You'll love Crete.
Your bond market.
Yes, Crete. Just say I need to go to Crete.
125.35. Our thoughts are with
Mrs.
Jordan Rochester from New York City. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. OPEC and its allies have reached a deal to inject more oil into the global economy. They overcame a split that threatened the cartel's control of the market. Saudi Arabia met the United Arab Emirates halfway in its demand for a more generous output limit. The OPEC Plus coalition will start pumping more oil. That's next month. Now, Prime Minister Boris Johnson's plan to get the UK back to normal is in disarray. Pandemic restrictions are ending here in England today, but COVID cases are rising the most than any country in the world. There were almost 48,000 new cases reported yesterday. Plus, Boris Johnson and the Chancellor, Rishi Sunak, had to reverse a decision after first refusing to self-isolate, despite being told to do so by the NHS. In Germany, those devastating floods have shifted the dynamic in the country's election campaign. Images of battered cars piled in gullies and floodwaters surging through villages have shocked German voters. That has left Conservative frontrunner Armin Laschet vulnerable in his bid to replace Angela Merkel and created an opening for the Green Party. The death toll is now approaching 200. And Zoom has agreed to buy call center provider Five9 for $14.7 billion in stock. That will bolster Zoom's popular video conference app against increasing competition. The acquisition could propel Zoom into the $24 billion market for contact centers. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
What's important is to help people understand that when you're talking about Build Back Better, when you're talking about the infrastructure framework, you're talking about measures that put downward pressure on prices by helping to improve and expand the economy's supply side.
Jared Bernstein there, the Council of Economic Advisors member from New York City this morning. Good morning. This Monday morning, alongside Tom Keene, I'm Jonathan Ferro. Lisa back with us next week. Kailey Leinz once again dropping by to help out. Your equity market down 32 on the S&P 500. We declined by 0.75%, coming off the back of a weekly loss on the S&P, the Nasdaq, and the Russell. The Russell getting really smacked around recently. Into the bond market we go with yields lower by 3 or 4 basis points to 125.35. Your lower to session 124.52. You've got Got to go back to spring for these kind of levels. Outside of that, euro dollar 117.76. Some dollar strength out there, Tom. Euro dollar negative 0.25%.
Yeah, loonie out near a 128. Just one example of the Canadian currency weaker against the dollar. And John, you're absolutely right. Smacked is right for the small caps here in the last number of days. John, look at the VIX, 20.32. That's a jump condition. The volatility of the Standard & Poor's 500. I'm not going to oversell it, but that shows you the angst of Monday.
Starting to pick up. This consensus, Tom, the consensus trades have totally broken down. There is no consensus anymore.
I agree with that.
Massive
issues.
I
agree. The only consensus is we're thrilled Kailey's with us today as Abramowitz takes her 14th week of vacation this year. Never on vacation, Anne-Marie Horton in Washington joining us right now. Anne-Marie, I just think the image that I saw maybe in the Post of the Times, can't remember, of Senator Portman exiting of Ohio said it all. There is chaos on the bridges and tunnel bill, right?
That's right, Tom. And also that picture, I know exactly which one you're talking about. It almost looked like an OPEC scrum where you had reporters and cell phones in his face from everyone who's trying to get away in the car. And he did get away, but the conversations continued. And Senator Portman said that on State of the Union. He's been in touch with the White House, in touch with the Congressional Budget Office, and also with other senators that are part of this bipartisan infrastructure deal. But as you say, there is chaos. Senator Chuck Schumer wants to go with a procedural motion today to get the wheels working in order to get this on the floor on Wednesday, and they still do not have a deal. They have not squared away how they're going to pay that bipartisan infrastructure deal. So where we start Monday morning is where we left Friday evening. The same.
Yeah, and you know, I don't even know if you've seen this. Alex McCammon and Axios, Anne-Marie, published in like 10 minutes ago on the conservative Democrats. They are in absolute revolt. Does the Senate Majority Leader have an understanding that a quarter or a third of his Democratic Party is just saying, wait a minute, we got to get reelected?
I think he does have an understanding because it's been quite out there and vocal in the press, especially from the likes of Senator John Tester, Senator Joe Manchin, which has said, I have not seen a single document yet. How do you expect me on Wednesday to give my blessing for this to go ahead? And this is all procedural stuff, but it would mean that then they would be debating this legislation, and they have yet to see it. And this is what some of the holdup is. And it's going to get interesting because the Senate moderates, the Democrat moderates, are saying we will go for the bipartisan infrastructure deal, making sure that it's paid for, and then we will also go for reconciliation, but as long as also those progressives sign up for the bipartisan. The progressives are saying, well, if you don't put what we like in it, especially when it comes to climate change, expanded child care benefits, then we will tank your bipartisan deal. So it's going to be a very interesting few days and weeks, I would say, here in Washington.
Well, let's start with Wednesday. You've mentioned it a couple of times. What's the ultimate objective of Wednesday, Anne-Marie?
The ultimate objective is to get the bill on the floor to start debating it. But what Republican senators are saying is that they want to make sure, and this is what Senator Rob Portman said in State of the Union this weekend, we want to get it right, not fast. So what he's saying, we might need a few more days because we don't want to even get to the floor. And then by the time it gets to the floor, they voted down to even start debate on it. They want to make sure that when it comes to the floor, they can get it to the procedural vote in order for it to begin debate on the legislation. And they say it's not even ready for that yet. So potentially Senator Schumer's timeline might be pushed back. What I personally think Senator Schumer might be doing is just setting up a timeline as quick as he can in order to really force negotiations through. We all know how these deals work, whether you're in Europe or the United States. Everything happens at the last minute.
So is that why the rush, Anne-Marie? I mean, why does it have to happen this week?
Well, this is the timeline Senator Schumer put forward, and of course there's an August recess. So they would like the Democrats to get this done before the August recess. Senator Schumer even said if we don't get it done, then potentially there won't be an August recess. So you can cancel all of your vacations and holidays within the United States or abroad. The idea is to hopefully get this done before the fall, and they definitely want to get it done before the end of this year.
What about the debt ceiling, Anne-Marie?
Yeah, July 31st. Yeah, well, July 31st, they need to make a decision, and there hasn't been a lot of discussions on it. The Democrats, potentially, we could do what they have done in the past. They could potentially put the debt ceiling limit part of reconciliation, but there hasn't been a whole lot of discussion. No one seems to be that worried about it just yet, but I imagine as we get closer to July 31st, this will start to overtake the infrastructure headlines.
Anne-Marie, just quickly, the Delta variant and the language that this administration is using. I think language matters, and the administration administration going with the line continuously that this is the pandemic of the unvaccinated. What's the policy discussion sound like in D.C. at the moment?
What they're doing right now, John, is they want to get out front in these communities that are not getting vaccinated, that are very skeptical of the government, skeptical of science, and they want it to be led by your local PTA meetings and your local physicians. What they are, though, also saying is they are taking a very sharp tone, blaming it on social media. I think the President of the United States even said it's killing people, this misinformation. But a lot of Senate Republicans are saying that we need to take a more localized approach to this. That is what they are trying to do. I mean, this administration wants everyone vaccinated, and you could see that in the numbers, because the places that the vaccination rates are not high, you have the Delta variant really taking control. The United States right now, in some of these places, are just an absolute uptick, and even Canada at this moment, which had such a slow start of the vaccination rollout, is now ahead of the U.S. when it comes to vaccination rates.
That is a turnaround. Anne-Marie, good to see you down in Washington, D.C., our Washington correspondent. If you're just tuning in for our audience worldwide, we're on the back foot this Monday morning to kick off the trading week. Equity futures down 32 on the S&P to 42.87 with negative 0.7%. Just on the politics and the Wednesday effort, Tom, Politico this morning, their line, Schumer channels his inner McConnell as he tries to push this through the Senate.
Well, it's one guy, the head beagle, if you will, and he's ramming this thing through, except he's got minimal support. I would go to the McCammon article in Axios that it's many Democratic parties, and they are not all on board with the Senate Majority Leader.
What did I guess call this last week, Katie? The Manchin flattener in the bond market.
Flattener.
What do you make of that, the Manchin flattener in this bond market?
Well, it's an interesting one. I feel like we just have a tendency to blame everything on Joe Manchin these days because he is the swing vote. And as soon as I read any headline about Washington, my first thought is, what does Joe Manchin think about this?
What does he think about this? That's usually the lead question to Anne-Marie. We have a flattener this morning. Your yield curve is flatter. Your yields are lower. Tom, your 10-year is at 125. Your 30-year is at now 187. Down
I'm
4
sorry,
basis
John,
points on the day.
99 basis points, 0.99 percentage points, 210 vanilla spread. That's a huge deal. We're not there yet.
We're 5 basis points away from there, Tom. We've got to talk about what some people are calling a growth scare. I'm not comfortable yet calling it that, with the kind of numbers that are delivering at the moment in this economy. We'll have that conversation with Carl Weinberg of High Frequency Economics. We'll do that next. From New York, this is Bloomberg. Live from New York City for our audience worldwide. Really fascinating start to the week. This Monday morning, equities start to move lower. We're down 30 on the S&P. We're negative 0.7%. Negative a third on the Nasdaq. A week of losses on the S&P, the Nasdaq, and the Russell. The small caps getting absolutely hammered recently. The small caps down again by 1.75%. Not pretty, you might call it ugly. Switch up the board and get to the bond market. 2s, 10s, and 30s. Your 10-year broke through the lows of 2 Thursdays ago. A 124 handle very briefly on a U.S. 10-year. Right now, 125. We're down 4 basis points on the day. On a 30-year, a break of 190, 187 on a 30-year, 1.8726%. That's yields lower, curve flatter, real yields deeply negative. We'll be talking about what that's signaling, what this bond market is saying. What is the bond market saying? We'll try and answer that question in just a moment. But this is what I want to finish on. Euro dollar. Euro dollar with a 117 handle right now at 117.71. The lows of March, 117. That was when we had the yields breaking out to the highs of the year. That's what I want to talk about a little bit later. It's a very different kind of dollar strength this morning. This much more defensive about the global economy compared to where the dollar was back at the end of March. So euro dollar back to where we were, Tom, when we were thinking about higher yields, validating better growth. This is a very, very different kind of dollar strength driving this euro lower. And HSBC out with a call for Thursday. They think the guidance might change for the ECB to come out and say no rate hike until the end of 2023. Now, I don't know many people who think we can get a rate hike this cycle from the ECB, but to formalise that in any kind of guidance would be quite a step. from President Lagarde this Thursday.
I strongly agree with you. There's a difference here to this dollar strength right now. DXY to bracket it, just printing a 93. That's important, 93.00. Bloomberg Dollar Index out even more. Stronger Bloomberg Dollar Index off of weaker EM currencies. On the Russell 2000, folks, I'd note up 46%, 12 months trailing. And as John mentioned, battered. It's down about 8% from the recent highs. If you have concerns about the global economy, about slowdown, this is the interview of the day. Carl Weinberg with us with High Frequency Economics, our chief economist, with a tour de force note this afternoon. Carl, one of the fundamental things you do is partition the United States and China from everyone else. Why do you do that?
Well, the U.S. and China are growing right now, and growth is far from assured in most other places of the world. We're looking at, industrial production, GDP figures that are pretty weak. Consumer spending is good in a number of countries, but overall growth has been disappointing, and forecasts are really not that great if you look at it coming from the central banks and from the official agencies. I'm just afraid that the world economy has now done its V-shaped recovery. It's now more of a reverse J-shaped recovery, if you will.
Jerome,
lower than we started.
Carl, Jerome Powell is central banker to the world. Will the global slowdown you write about, and frankly George Saravelis at Deutsche Bank touches on this morning, is that enough to affect Powell's domestic policy?
Oh, absolutely. And in fact, I think among central bankers right now today, the thing that worries them the most is not inflation, which all of them have clearly said is transient in terms of the things that are going up, just a small number of prices going up for a short period of time. But they're worried that the world is going to fall back into a recession or into a period of subpar growth with the unemployment rate elevated and with both fiscal and monetary policy tapped out. That's a nightmare scenario for central banks, and their job is to minimize the chances of the worst possible outcome. And that is the worst possible outcome. That's why all central bankers, I believe, are reluctant to talk about tapering or interest rate hikes and say the conversation is way in the future, because it is.
Carl, this line that comes from you, the winds of global recession are already in the data. A lot of people might be listening to this saying, which data where? Because I'm looking at economic data right now and it looks really strong still. No sign of insufficient demand anywhere. What's the leading indicator for you, Carl, both in terms of the region and the kind of data that you would look for?
Yeah, well, a lot of people are looking at PMIs and they're saying, well, the PMIs are up and that means that the economies are booming. But we have to remember that it's the economy that causes the PMI to move and not the PMI to cause the economy to move. When I look at industrial production, I mean, starting from the view that everything that matters in this planet is either grown, hammered together, or dug out of the ground. All right. Well, hammering things together is very important because it drives all of services. And I look, as I do in my global note this morning, at industrial production charts from a dozen countries, and all of them are pointing downward. And all of them are furthermore continuing downward trends that started as long ago as the end of 2017, early 2018. So it makes me think that we're in the process, in a longer-term process of industrial decline that has both a cyclical as well as a secular component. I'll also point out that industrial production, almost every place I look in the world except for China, is lower now than it was in March of 2008. Well, it reaches a point where we may want to start connecting the dots between what happened in 2008 and what's happening now and viewing it as one longer-term episode, but we still have to fix what's wrong.
Carl, let me just sort of summarize as follows then before I get to the big call. Can you just help me understand the time frame for this call? When you talk about this cyclical downturn in the future somewhere, what's the time frame for that?
Let's just start off with right now with the immediate problem. The immediate problem is that we're lower now on industrial production than we were in February of 2020 before the pandemic, and we're not getting closer back to those levels. We're moving further away from it. That's the immediate problem. The longer-term problem is that we're also lower than where we were in 2008, and while we may have briefly rebounded from that, if you connect the dots and run the regression line from 2008 to today, it's pointing downward, and that's a longer-term problem that involves infrastructure, investment spending, and demographic trends.
Can we talk about the fiscal part of this equation? We were just discussing with our Anne-Marie Horton down in Washington the debate over the bipartisan infrastructure package and then, of course, the trillions of dollars that they're going to attempt to push through budget reconciliation. How do you factor in that long-term spending?
That's a really good question, and we have to separate the long-term issues from the short-term issues. And of course, the only way to get to the long-term is to get through the short-term. But in the longer term, the only way we're going to grow in any meaningful way is if we increase productivity, because our population growth is slowing, and productivity plus population growth gives you long-term economic growth. So I encourage and I support, and I think it's great for the longer-term outlook to get more investment spending in there so that over the next decade, we become richer rather than poorer as our population growth rates and demographics change. In the short run, though, that's not going to help very much. The net impact on GDP in the very short term is going to be relatively small. It will create jobs. It will certainly help the environment, and that's probably the most important reason for moving forward quickly with it. But the cyclical problem, the shorter-term problem, has its roots in, I think, credit growth outside the United States, which is flat or down in most of the economies that I'm looking at. That's probably the most important short-term issue, much more important than infrastructure.
While we're talking about economies outside the United States, it's Freedom Day in the UK. It should be a happy day. Restrictions are being lifted. Great. Not so great is the resurgence in COVID cases the country is seeing because of the Delta variant. How big do you think the economic pickup there will actually be, given some of those remaining fears?
Well, you're asking me to look into a crystal ball that's yet to be delivered to my doorstep. We've never seen this before, so we don't really know. What we do know is we're getting anecdotal evidence that companies are having trouble operating because of absenteeism in the UK, that 50,000 new cases a day are generating maybe 500,000 absentees from work, and that's causing production chain problems everywhere along the line. And this is stuff we have no basis to evaluate because we've never seen it before. So let's say that I'm worried about it. And at the end of the day, in the very, very short term, the course of the virus, the course of the pandemic is probably the most important short-term consideration, much more important than tapering or interest rates or anything like that.
Carl, very quickly here, what's the timeline of getting U.S. GDP back to something on the edge of normal, say 3% or under 3%? Is that sooner rather than later, or can we extend that out?
No, it's later rather than sooner. Look at 2008, when everything seemingly went better after 2009, and it still took us, I don't remember the exact time frame, 3-4 years to get GDP back to where it was, and to get the unemployment rate back to where it was, it took almost a decade. Right? Economies do rebound, and initially they rebound quickly, but then the pace settles down to a slower pace as the harder to reemploy take time to get back to work. So this is, this is a marathon. It's not a sprint. And the idea, of course, is to get the unemployment rate back down to where it was before the next hit comes. And this is what central bankers want to ensure.
Carl, it's good to hear from you, to get that view. Carl Weinberg there of High Frequency Economics, the Chief Economist and Managing Director, on a less constructive view of the global economy right now. Here's your market. Equity futures down by around about 33 points on the S&P 500, declining 0.7%, and yields, Tom, near the lows of the session, 125 flat on 10s.
And declining as we go in, the real yield spread goes to an ever greater negative yield. John, the VIX out almost 2 big figures. John, moments ago, Lisa Dew reports U.S. Olympic gymnast tests positive for COVID in Japan.
Yeah.
Nowhere in the article do we say if they're vaccinated or unvaccinated.
I've noticed that. Did you notice that with the Yankees last week, Tom?
I just don't get it. I mean, how can you be like going to the Olympics and not be vaccinated?
Well, from what I understand, Tom, and I don't know about this particular case, but a lot of athletes chose the J&J vaccine, which may offer less protection against some of these emerging variants. I don't know if there's anything in that. We can talk to Joshua Sharfstein at Johns Hopkins about that, Tom, in just a moment.
Yeah, it's just bizarre. Absolutely.
No, I agree with you. It's totally bizarre. We've got to focus on two things, I think, for market participants. Cases are up. How does policy respond, and how do consumers respond?
Yes.
And right now, policymakers in some places, Kailey, starting to respond.
You're seeing that in LA County for sure, John, but you also are seeing in the UK still a reopening despite the fact that the virus trajectory seems to be growing worse. I think there isn't much appetite at this point to return to more restrictive measures. Telling people in LA County to wear a mask is one thing. Shutting any kind of businesses down is entirely different, and I'm not sure that there's public appetite for that anyone would really abide by that.
Have we broken the link between cases, hospitalizations and deaths? That's the conversation we need to have with Joshua Sharfstein at Johns Hopkins Bloomberg School of Public Health. The Vice Dean joins us very shortly. If you're just tuning in, equities down 0.75% on the S&P. Yields are lower by 3 or 4 basis points, 125 on 10s. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. OPEC and its allies have overcome an internal split that threatened its control of the oil market. They reached an agreement to inject another 400,000 barrels of crude a day into the global economy. Saudi Arabia met the United Arab Emirates halfway in its demand for a more generous limit on output. Now, the American father and son team that smuggled former Nissan chairman Carlos Ghosn out of Japan are going to prison. A Japanese court sentenced Michael Taylor to 2 years. His son, Peter Taylor, received a 20-month sentence. They pleaded guilty to aiding Ghosn's escape to Beirut. U.S. companies in Hong Kong want reassurances from China that it will prevent any erosion from the city's business environment. That is after the Biden administration issued a warning about operating there. The president of the American Chamber of Commerce in Hong Kong told Bloomberg TV that companies hope unrestricted internet access and the free flow of information will continue. Now, Bill Ackman will buy a stake in Universal Music Group with his hedge fund rather than his blank check company. U.S. regulators looked ready to block the planned deal, citing stock exchange rules. Ackman's Pershing Square holding will now buy 5 to 10% of the music label. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
For our children under 12, and I say that as a dad who's got 2 kids who are 4 and 3 and who don't have a vaccine available to them yet, our kids depend on us, the people around them, being protected, being vaccinated in order to shield them from the virus. And that's why, again, it's so important for us to get vaccinated.
Vivek Murthy there, the U.S. Surgeon General on ABC this week. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa back with us next Monday. Another week's vacation for Lisa Abramowitz. She deserves it, Tom. Kailey Leinz dropping by.
Maybe.
To get up to speed on this downdraft in this equity market, 42.87, we're down 31. We're negative 0.7%. There's some dollar strength out there. Euro dollar, negative 0.25% to 117.76. There's a bid into this bond market. We're firmer, yields are lower. We're down 4 basis points. Your nominal yield, 124.69. We're back with a 124 handle. And Tom, you mentioned real yields in a commercial break, so let's go there. Negative 1.1. Now, if you round this one down, elsewhere, if you look at where the lows were, Tom, we were just south of 112 at the start of the year.
Yeah.
So that real yield, positive correction that we saw through to the end of March, that positive growth shark, we've unwound pretty much all of that. In fact, we've unwound pretty much all of it right now, Tom.
Yeah, it's 6:48 Wall Street time. What you need to know is there's a deterioration this morning. We really haven't seen a bid off of this caution in the market. The VIX now 2.02 points. On the pandemic, and yes, this weekend was different in the great stretch of this natural disaster. We are thrilled to bring you Joshua Sharfstein of Johns Hopkins Bloomberg School of Public Health. Of course, Mr. Bloomberg, leader and owner of this radio and TV operation. Dr. Sharfstein, I'm going to cut to the chase. You were at Harvard undergraduate, winning the prestigious Hoops Prize. You did Harvard Medical as well. You were at Boston University Hospital. And what you did is you studied Fleming, you studied Salk, you studied Watson and Crick. You also studied Sharfstein. Guess what? There was no social media. How did guys like you and your profession adapt to virology and microbiology in the time of social media?
Well, we're seeing just how challenging it is. The misinformation that's out there, the fact that people are hearing again and again and again things that are just flatly untrue about the virus, just shows how powerful a force it is. We don't have that kind of partisan divide on penicillin, but we have it on a COVID vaccine in the middle of a pandemic.
Well, let's talk about who are the unvaccinated, Doctor, and what policymakers are looking to do about it.
Well, they're not all the same. I think that there are a couple of different ways of looking at them. One way is, there's still people who are open to getting vaccinated. They just want it to be really convenient. And I've met them. I've been out vaccinating. I see people who say, this is so easy because I can just walk down from my house. And so I decided to go do it, and I'm going to bring in some friends. And you think, that's great. We're here. That's why we're doing this big outreach campaign. There are other people who you really have to spend time with. And I've been talking to people at different workplaces, or just friends of friends call me, talk it over. Some of them decide yes after a conversation. And then there's some people who really are dug in that they don't want to get vaccinated. And I think that number is a large, I haven't seen recent polls on that. Initially, it was in the 10% range, but might be higher now with all this misinformation. And these are the people who, they get COVID and they almost die. And they said, well, what do you think about getting a shot now? And they go, I'm not so sure. I hear it might not be safe. And you got to scratch your head and go, like, how could you have that view, given that there are 150 million plus people who've been vaccinated safely and you almost died from COVID. So it's really difficult when you get there.
Doctor, we have to have a sensible approach to these conversations. And I think you're right to draw a distinction between anti-vaxxers and people who are just hesitant about taking a vaccine. These vaccines are being deployed under emergency use authorization. I just wonder if full authorization, so to speak, Josh, would help things just a little bit, maybe on the margin, if at all. Your thoughts?
I do think it would help, and I think it's important for the U.S. Food and Drug Administration now to be really explaining that process. I thought it's been important for a while. What is the difference? What data are they bringing in? What is the timeline? I think there are a lot of people who are confused, and I think just the we'll be really quiet until we tell everyone it's licensed approach isn't good enough for the pandemic. There should be more transparency. And I think that will affect some individuals who are waiting for that, but it will affect businesses a lot, particularly businesses who are wondering about requiring vaccination or really pushing vaccination for their employees, but are waiting to see what the FDA does.
Doctor, I was catching up with a friend who's down in Florida over the weekend, and she says she knows about a dozen people who are fully vaccinated and yet are sick, once again, have tested positive for COVID-19. What do we really know about the protection that vaccinated people have, especially with the surge of the Delta variant and others for that matter?
Well, there's extraordinary protection against serious illness and death from the vaccines. It's not perfect, but it's very, very rare. I'm guessing those 12 people did not get particularly sick. But you can get infected. There's still very good protection against any infection for the Pfizer, Moderna vaccines. It looks like for 2 shots, people who are fully vaccinated, it's in excess of 90%. But that doesn't mean there won't be some people who are exposed, and people who are really opened up their lives and are doing things might well get a little bit sick or test positive, for example. But in general, if you're vaccinated, it's very, very unlikely that you'll get sick.
Joshua Sharfstein, it's good to catch up. An important conversation, and it gets more important by the day in a way that I think some people didn't anticipate. Johns Hopkins Bloomberg School of Public Health Vice Dean. Got to do a couple of things, some developing stories right now. Kailey, let's start with that Robinhood IPO. Just some of the details coming out. 55 million shares, John, pricing at $38 to $42 a share. Of course, the founders and CFO to offer an additional 2.65 or so million shares. But of course, we've been waiting, John, for what feels like a really, really long time for this Robinhood IPO. We, of course, got the prospectus a few weeks ago, but now we're understanding 55 million shares, $38 to $42 a share, John. Some of the numbers to look at and a developing story to keep an eye on, Tom, this morning. This morning across the Bloomberg terminal, China's state security involved in cyber intrusion. This coming from the United States, Tom. 4 Chinese nationals have been charged with computer intrusion.
This is from the Department of Justice, John, and the first thing I did was look to get an update on Huawei and Vancouver and these fractious relations between China, between Canada and the United States ends up being a legal process. That Vancouver process with the daughter of the Huawei owner is still in process in Vancouver, and now you've got this.
And when these things play out more publicly, Tom, it's just another sign that things are breaking down between the U.S. and China.
Yeah, I really think so. I mean, we need a lot more reporting on this. It's just one discrete headline, but nevertheless, there it is. And frankly, John, it does fold over to what we do here. It folds over to international confidence.
That is a developing story we'll keep an eye on for you this morning on TV and radio, as we will on top of the price action as well. Your equity market, a gap lower on the S&P. We're down 32. We're negative 0.75%. A week of losses turns into a morning of losses. Coming off a week of losses into Monday, we're negative 32 on the S&P, and yields are lower too by 4 basis points to 125.02 on 10s. Your dollar is stronger. That takes euro dollar back down to 117.73, negative 0.28% on that currency pair. From New York, this is Bloomberg.
We may once again be surprised in the second quarter to see earnings being much stronger than maybe we might have thought.
You're going to see the economy move into a position of excess demand.
I think we have seen the peak in rates probably for the cycle. There could be another twin peak later on.
We think that the Fed is correct, right? That inflation is transitory.
If you do get this sort of sense from the Federal Reserve towards August, September, that they're looking towards tapering their asset purchases, a lot of traders are going to be caught off guard.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is a risk-off Monday morning from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Lisa back with us next week. Kailey Leinz on top of the price action for us this morning. Down 34 on the S&P, Tom. 42.85. We're down 0.75%.
Somebody emailed in and said, is Lisa on Crete? I said, I don't think she's on Crete.
I don't think so.
Don't know where she is. John, this is a really, really important market. Bitcoin craters, and we're going to go to that on gold here in a moment. But John, this market speaks volumes, and I need to say, John, in the last 60 minutes, there's been a deterioration in the tape.
A 124 handle on 10s once again, Tom. 124.69. We're down 4 basis points on the day.
The curve flattening is out there. What'd you call it, a mansion flattener or something?
Some people calling it
That's
that,
not
Tom.
in Fibonacci.
I'm not calling it
2
that.
cent spread, 102.89. That deteriorates. The real yield comes in as well. You can start here and there. What I would start with, John, is the dollar rally, as you mentioned earlier, is of a different character than we've seen 2 times before.
Euro dollar back to 117, where we were in spring, but this one is very different. This is risk aversion. We'll talk about that through the hour. Here's a headline for you, Kailey. The United States to attribute the Microsoft hack to the Chinese government. There's an escalation.
There is an escalation. It seems like a series of escalations, frankly, that we're getting, John. Of course, we have accusing them, attributing a hack to the Chinese government today. Just on Friday, we had Joe Biden issuing a warning to U.S. companies about doing business in Hong Kong. Was that really a warning to U.S. companies, or was that an indirect warning to Beijing? It seems that the shots across the bow just keep continuing, and tensions between the 2 largest economies in the world do not seem to be easing. Really at all, John.
And Tom, the important point here, it's not just the United States, it's a group of allies as well that includes the EU, the UK, Australia, Canada, New Zealand, Japan, NATO. And as our colleagues point out, the first condemnation by the North American European Alliance on China's cyber activities. This according to a official familiar with the matter. Tom, that is a real escalation.
It's a real escalation. And 20 minutes ago, maybe 15 minutes ago, we had that single headline from DOJ on some action against some Chinese officials or Chinese linkage to Chinese employees. I wonder if those 2 stories are linked together, John.
This is the story right now. We de-risk. We gap lower on your equity market.
I like that. We're
42, 88, down 0.7% on the S&P 500. Let's whip through things for you. Yields are coming in by 4 basis points, 124.85 on 10s. Yields are lower, much lower over the last couple of months. Outside of that, in a foreign exchange market, we mentioned this, euro dollar going into Thursday. Your ECB decision and news conference, Kailey, euro dollar 117.79, negative 0.2%.
And we have to note crude as well. WTI back below $70 a barrel for the first time since early June. Of course, that has everything to do with OPEC+. So something to keep an eye on today. What else to keep an eye on today? We are getting some economic data, 10 a.m. Eastern time. NAHB Housing Market Index. Does it improve from June, which was the biggest, worst reading in about 10 months? You have lumber now 56% off of its highs for the the year. Does that improve sentiment for the home builders? We will wait and see. Economists looking for an 82 print on that number. Then after the bell, it is, of course, earnings season. It's in full swing this week. IBM will be reporting post-market. I'm sure there will be some questions on executive change-ups on the call, but also, of course, looking at sales growth and how that cloud computing shift is really doing for the company. And finally, it is a happy day in the UK, maybe, in that it's Freedom Day, but I'm not sure Boris Johnson is feeling all too celebratory, considering he is self-isolating until next Monday after exposure to the Health Secretary, Sajid Javid, who has tested positive for COVID-19. Of course, cases in the country, John, getting worse, and yet restrictions still are lifting today.
Travel stocks not having a good time this morning over in Europe, Kailey. Thank you. EasyJet down by 5.8%. Carnival down by 7.2%. The airlines in America down more than 20% from the highs a number of months ago. Tom, it's not been pretty for these travel stocks.
No, it isn't. And it's with the COVID worry over the weekend. You wonder where they're going to be in a couple of weeks here. I would say, John, on the other side, and as Carl Weinberg partitioned out America, we've got some tech earnings coming up in a few days.
Netflix this week, and then it really starts to pick up next week as well, Tom. Let's bring in Matt McLennan, shall we? First Eagle, co-head of Global Value. Matt, it's good to catch up. Let's just start with this bond market. How can you get the banks trade to work with 10s back through 125? Just walk me through your thinking now, sir.
So, the issue for obviously banks is that they have these large deposit floats that haven't been earning much with interest rates so close to zero. And they had done pretty well as interest rates had backed up here. But as you point out, the flattening of the curve makes it more difficult for sentiment. I think the key is to sort of step back from trying to predict where the bond market's going to go and identify those banks that have sustainable earnings power not linked to their balance sheet. And so that's one of the things that we've tried to focus on doing.
Matthew, good morning. Tom Keene in New York. And we should mention to run the fun off of the great Jean-Marie Eviard is really a wonderful thing. First Eagle is about focusing on minerals and about focusing on gold. Have you aged every time you hear someone link Bitcoin to gold?
Well, Bitcoin is an amazing algorithmic innovation in a sense. And, I think for many people, they started out seeing it as a form of almost black market gold. But as the server network behind Bitcoin became global in its scale, I think it's better off being seen as some form of call option on being a digital gold, if you will. And, I think it's fair that people have asked questions about that. Having said that, gold has been around for millennia. And, you have to weigh that against the network that is relatively youthful. Bitcoin's 12 years of age. And so, we're taking a wait and see approach here. We think it's an interesting development. But meanwhile, in an environment of double-digit money supply growth, the supply growth of gold is below 2%. And so that's one of the things that helps it maintain its store of value.
Is the disinflationary correlation still there in gold? Is the gold movement now the movement we knew 10, 20, or 30 years ago with the younger Jean-Marie Eviard?
We do believe that gold has continued to trade as a rational sort of store of value. So if you look over the last decade, it's had a pretty tight inverse correlation with real interest rates and with the dollar. And so in the short term, it's exhibited characteristics you would expect from a potential hedge. And, over the longer term, it's maintained its value relative to money supply growth. And so if you want to hedge for the long term, something that is inversely related to real interest rates and perceptions around risk and the health of the economy, but over the longer term, has preserved its value relative to money supply growth. I think gold still maintains its luster from our standpoint.
Speaking of the health of the economy, should I be reading into the pain we've seen for small caps in that it's down 8.3% from its peak in mid-March and futures down another 1.8% this morning? Can you even play the small cap trade right now?
So confidence doesn't breed opportunity from our standpoint. And I think part of the problem for the small cap market and other segments of the risk market, it's not just small cap that's down. The Chinese equity market's been in a bear market. We've seen a bear market in the crypto space. And so we were in an environment of what I would say is sort of elevated confidence. You had the Purchasing Manager Survey close to generational highs. You've had record IPO activity. All of these things were signaling confidence being a little above what was sustainable. And I think at the margin, the tide coming out, whether it's the Delta variant or perceptions about growth rates decelerating around the world, I think is a healthy thing for markets.
Matt, let's wrap things up and put a bow on it with your question. Should we pivot from the fear of missing out to the fear of wiping out? Are we pivoting from the fear of missing out to the fear of wiping out?
Well, it's very difficult to call the market zigs and zags. What I would say is we were in a fear of missing out type environment. And I think in an environment like that, it's worth regrounding oneself and sort of focusing on cash flow generative businesses, things that have survived the test of time and that could still hold their value in a moment of market panic. We'll just have to wait and see if that's what we're going to get. But I think if you own businesses that have incumbency value, you have a potential hedge in something like gold, you can kind of weather those storms with a degree of equanimity. That's perhaps more challenging if you're trying to bet on the short term.
Matt McLennan, good to catch up, sir. First Eagle, co-head of Global Value. I want to summarise a story that came out just a moment ago at the top of the hour, Tom. The US, UK and allies formally attributed the Microsoft Exchange hack to act as affiliated with the Chinese government. And the US and other nations are joining in that assessment, escalating last week's tensions between the US and China. Dominic Raab, the UK Foreign Secretary, this is his quote, Tom, in the article from our colleagues this morning. The Chinese government must end this systematic cyber sabotage and can expect to be held account if it does not.
This has gone viral in minutes, folks. I see it out in the zeitgeist right now. John Filane, Jenny Leonard, and Carter K. Matorta writing on this. John, buried in the article is the linkage to that DOJ headline that we saw 45 minutes ago, and that 4 Chinese nationals have been charged by the Department of Justice. This is a way bigger story than the headline blaming the government. No, this is about actual legal action.
How does this fold into commercial issues, Tom? Investable opportunities in tech in China, business opportunities of Chinese tech firms being in places like America.
Yeah, I'd say it's there, John, and I would say that's a moving story. But to me, it's much more, again, buried in the article about ransomware and the fears we have, particularly for small business, that one day you're just shut down.
The broader story here, you've got to throw in the IPOs, the tech IPOs in the United States. Investable opportunities for Chinese tech, for US tech. There's this hard line being drawn down the middle of the map right now, Kailey.
There is indeed, John.
Coming up in the next hour, we'll be catching up with Tony Rodriguez, Nuveen Head of Fixed Income Strategy from New York. Equity futures 42.82, down 0.809% in the equity market. Yields come in 4-5 basis points, 124.35. For our audience worldwide on radio, on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Leanne Gerrans. OPEC and its allies have reached a deal to inject more oil into the global economy. They overcame a split that threatened the cartel's control of the market. Saudi Arabia met the United Arab Emirates halfway in its demand for a more generous output limit. The OPEC Plus coalition will start pumping more oil next month. Now, Prime Minister Boris Johnson's plan to get the UK back to normal is in disarray. Pandemic restrictions are ending here in England today, but COVID cases are rising more than any other country in the world. There were almost 48,000 new cases reported yesterday. Plus, Johnson and Chancellor Rishi Sunak had to reverse a decision after first refusing to self-isolate. Now, that's despite being told to do so by the NHS. The US and European Union says cyber attacks conducted from China have compromised the Microsoft Exchange server. That's affecting thousands of computers and networks worldwide. The EU denounced the attacks and called on China to stamp out activities undertaken within its borders. Robinhood hopes to raise up to $2.3 billion in an IPO. The trading app company at the center of this year's meme stock frenzy says it will sell more than 55 million shares. Robinhood expects the IPO to price between $38 to $42. The company's monthly average users have more than doubled, and that's in the past year. Zoom has agreed to buy call center provider Five9 for $14.7 billion in stock. That will bolster Zoom's popular video conferencing app against increasing competition. The acquisition could propel Zoom into the $24 billion market for contact centers.
of IRS reform or IRS tax gap, which is what was in the original proposal. That will no longer be in our proposal. It will be in the larger reconciliation bill, we are told.
That was Rob Portman, the Republican from Ohio, from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Kailey Leinz. Lisa back with us next week. Let's get straight to this price action this Monday morning, Tom. A gap lower of 0.8%. We're negative 36 points on the S&P to 42.82. Outside of that, the attention very much on the bond market. Your lows right now of the day. 124.35. The lows right now, we're just off them at 124.69. We're still down 4 basis points and well off the highs of the year. 177 intraday. Tom, that feels like a long, long time ago. That was the end of March. And we've got some dollar strength in the mix too. Euro dollar negative 0.25%. Euro dollar down to 117.78.
Fixed income moving, but the Dow off record highs, John. I just recalculated this just that it's well known, John. The Dow Jones Industrial Average is an important index. A correction is under 32,000, plus or minus 100 points. I'm not sure. We're a long ways away from correction
Are you waiting
territory.
for me to say something about that? I'm not going to weigh in. I'll talk about the S&P just briefly. I'm
Please
with
do
you.
that.
Down a little more than 1% from all-time highs on the S&P. But a part of the market, Tom, which has been absolutely punished, and Kelly mentioned it in the previous hour, small caps. The Russell was down 5% last week alone. Worst week of the year. It's been rough. We haven't seen a high there, I don't think, since the middle of March on the Russell. It's been that long.
It's near a correction, down 8% or so right now. So small caps out front here on the lead. Right now, we've got 14 things to talk to Martin Schenker about, our editor-at-large, managing editor for the linkage here of all we do to politics. But we need to rip up the script on China. We do that right now. Marty, this important reporting by John Filane and the rest of the team at Bloomberg, and it dovetails into 4 Chinese nationals taken into some form of legal process by the United States this morning. This is a huge deal.
Yeah, you know, the top level issue here is that the Biden administration coming in had said on China that, excuse me, that they want coordination with our allies. And today, with this accusation that the Chinese are engaging in cyber attacks on critical institutions, is just that.
And John, you mentioned Dominic Raab over in the United Kingdom. I mean, this speaks of what we saw at the G7 meeting and then on to Geneva.
Well, let's bring up his quote. The Chinese government must end this systematic cyber sabotage and can expect to be held accountable if it does not. Marty, the final piece of that line, that quote from the UK Foreign Secretary, it can expect to be held accountable if it does not. How do they intend to hold the Chinese Communist Party, the government in Beijing, accountable?
Well, that's the major question, right? So far, there have been lots of threats, not just to China, but, for instance, to Russia as well. But we have not seen any tangible response yet from the Western governments on punishing either China or any of these other actors.
This is the issue, isn't it, Marty? The approach has changed, but the objective is the same. We're trying to get China, Beijing, to change its behavior. This administration is trying to do that in a more multilateral, bilateral fashion. And I'm just wondering, Marty, whether that's going to end up with a different result or not.
Well, that's quite clearly the question. And, you know, it's also against a backdrop with trade with China, in the U.S. anyway, is still at record levels. The codependency with supply chain and the other institutional connections are going to be very difficult to break without pain on both sides.
What is our reporting, and Marty, this is what you're so good at, is what is our reporting on the change behavior of our financial institutions in Hong Kong? Not specifically to this article this morning, but is there any change behavior, or is it business as usual?
There doesn't seem to be any concerted response to the Biden administration warning about operating in Hong Kong. Look, the infrastructure that connects the financial markets of Hong Kong and mainland China are unmatchable anywhere else. So the banks and the financial institutions, certainly, if they want to do business there, they're going to have to stay in Hong Kong.
Marty, this was a question I asked on Friday when this advisory was issued, but was it really meant for the banks, the companies that operate in Hong Kong, or was that a message really meant for Beijing?
Well, clearly it was meant to tweak Beijing. And there's no question that Hong Kong as a financial hub is a critically important source of financial power for the Chinese government. They don't want to see anything upset that aspect of Hong Kong. So it certainly tweaked them.
Marty, there seems to be some bipartisan consensus around countering China. We saw that bill advanced in the House last week. Where there doesn't necessarily seem to be that much consensus is, of course, on infrastructure. You have that bipartisan package that Schumer wants to take to the floor on Wednesday, but you're starting to get some pushback from Republicans like Rob Portman, for example. What is the likelihood that you see that we actually will see action on that this week?
Well, you know, this is a critical week. Chuck Schumer's decided he's going to fast walk this compromise, this bipartisan infrastructure bill, and now the Republicans who supported it are kind of getting tremendous pressure from their colleagues to slow it down at the very least. So this week is critical, and your guess is as good as mine whether Schumer is going to get it through.
Marty, it's good to catch up. As always, fantastic to lean on your experience. Marty Schenker there, Bloomberg editor.
You never lean on my experience.
I try to, Tom. You bring up the Dow far too often.
You give Schenker love. I don't get any
I know,
love.
but Marty doesn't mention the Dow like you mentioned the Dow. That's the divide.
Yeah, that's true.
If
That's
you lean into the
difference
S&P
here.
like Marty is leaning into the S&P.
Down on 348 points.
Thank you, Tom. Appreciate that. We're down 35 on the S&P. We're negative 0.8 of 1%.
Kaylee, you want to weigh in here?
Do you want to pick an index, Kaylee?
Oh, I'm just having fun watching you guys.
Thank you. You enjoy yourself. Yields down by
It's
4
very
basis
entertaining.
points on
Such a
10s.
tool.
124, Tom. 124.35 now. Basically at the lows of the session for a US 10-year, Tom.
Yeah, I'm watching real yield. Remember, let's define this right now, John. I think it's important. You've got a nominal yield, which is what John's quoting, 124. You've got the inflation expectation. You take that away, and then you've got the residual, which is the so-called real yield. So they don't move directly linked. All I know is I got a negative 1.09, John, and that's awfully close to a negative 1.12.
Yeah, and the negative 112 that you point out, Tom, the lows of the year. And it's important that you bring that up because what we're unwinding here was this immensely large positive growth shock that we experienced through to the end of March. This is when people were aggressively upgrading their outlook for the US economy. We're pricing in higher real yields. And Tom, we've really unwound that. In fact, we have totally unwound that now over the last several months. And my issue with the bond market at the moment, you pick an expert right now. Pick someone on Wall Street, a strategist, someone on the buy side, the sell side. There is immense confusion on what is going on in this bond market at the moment.
I'll get you unconfused. We protect the copyright of all our guests. Get it from MKM Partners. Michael Darda's research note, John, this weekend was a tour de force. He and I talked about it when he was with us, I believe, last week. In the basic economic theory, there's the IS curve, the real economy, and the LM curve, which is the monetary system. And Darda says this is different. It's about monetary dynamics and not the real economy.
10s right now, you're low, 124, very close to a 123 handle at the moment, Kaylee. Unbelievable to look at this gap lower.
Well, and the breakdown of the relationship between yields and the dollar too, John, because in the first quarter it was higher yields, therefore a stronger dollar. Now we have lower yields and yet still a stronger dollar. Bloomberg Dollar Spot Index at its highest since March 31st, John.
Dollar back to where it was, but this is a very different kind of dollar strength. I'll cover that in just a moment. 117.78, euro dollar negative 0.2%. Your bond market threatening to break into 123 territory at 124.19. From New York, this is Bloomberg. Live from New York City for our audience worldwide on TV and radio this Monday morning. Good morning. Here is the price action, 42.77. Coming off the back of a week of losses and adding to those losses, we take more weight off the S&P, the Nasdaq, the Russell. We're down 1 full percentage point on the S&P. On a Nasdaq down by 0.8%. And after a loss of 5 percentage points last week on a Russell, worst weekly performance of the year so far. The small caps down again by 2 percentage points this morning. It's ugly. Capturing the ugliness. 2s, 10s and 30s in the bond market. Switch up the board. Your yield as follows on 10s. 123 handle. Starting to move a little bit lower again now by 5 or 6 basis points. 123.36 on 10s. Right now 30s. 184.90. 123.36 right now. Highs of the year intraday 177. That was at the end of March. On April 2nd, we were looking at 172-ish. On a 10-year. Why do I mention April 2nd? Switch up the board because your dollar is the strongest since April 2nd. So here's the difference. We're in the 170s the last time the dollar was here. back at the end of March, start of April, and now we're in the 120s, 123. So what's going on? Your dollar index back out to 93, Tom, at 92, 96, just south of that level. This is a very different kind of dollar strength. In the first quarter, it was about U.S. exceptionalism. In the middle of this year, going deeper into July, this is very much about risk aversion and dollar strength being the wrong kind of dollar strength for this kind of market right now, Tom.
I think we got to pause here. We're going to go to a guest here in a moment. We've got some other stuff on stocks to do as well. John, I am going to suggest this retreating yield that we've seen in the last 20 minutes is off the Bloomberg story. I don't have any reporting on that. I'm just observing the news flow and this new tension between China and the United States. You really have to wonder if it's price up, yield down on the 10-year.
Just adding to some of that tension right now. Dollar strength, the story, 92, 96. The bond market bid, yields lower, threatening to break into 122, just about holding on to 123 at 123.02 in this bond market.
Just got a 122, John.
Wow. In this bond market, we keep gapping lower. Your equity market is heading south by 45 points on the S&P. And in Europe, underperforming all morning has been travel. And that story is going to be no different stateside. Kailey.
Yeah, that's absolutely right, John. You're seeing it reflected in pre-market trading. The airlines, the cruise lines, all under pressure. Of course, there are concerns about the Delta variant really overlaying all of this. But you also have a court slapping down a ruling that was going to ease up some of the pandemic restrictions on cruise lines. And as a result, those are under pressure a little bit more today. You have the likes of Carnival, Norwegian, Royal Caribbean, all down 4% or more, even 5% in the case for Norwegian. American Airlines, for its part, is down about 4 full percentage points as well. There are some more idiosyncratic stories also going on beneath the surface, including some deal action. Zoom, of course, trying to make sure that it can last post-pandemic. It is buying Five9, which is another call conferencing service, for $14.7 billion. All stock deal. It was about $200 per share as of Zoom's closing price on Friday. As a result, Five9 is trading at $191.50, up about 8 percentage points, while Zoom is lower by about 2 percentage points. We also have Facebook lower by about 0.9%. Of course, Joe Biden talking about the misinformation out there related to COVID-19 percolating on social media platforms like Facebook, saying they are, quote, killing people. So some harsh words from the president of the United States. And finally, I just wanted to point out Virgin Galactic as well. In the last 6 sessions, down 38%, even after Richard Branson's successful flight nearly up to space, not quite past the Kármán line, but he did get up there to see the curvature of the Earth. It's down about 6.5% again this morning, John. Maybe a little bit of selling ahead of Jeff Bezos heading up to space tomorrow, Tom.
And we'll have to see on that. There is a sighting, and that's not for the Blue Origin blast tomorrow. It's Emily Chang is now in Texas leading our coverage from the Blue Origin space. I believe, John, all the way from L.A. She listened to Toby Keith to get ready.
Thank you, Tom.
For
our special coverage tomorrow. Do you want to promote that?
Oh, we should do it tomorrow as well. We're starting.
8:30 Eastern, we'll start some special coverage. Tom and I will be hosting that. Emily Chang will be helping out a little bit, Tom, as well. Whole host of reporters coming together from both Bloomberg TV, radio, and Quick Take. Looking forward to that. 60 minutes, I think, Tom, through to 9:30 Eastern, and then I'll run away and we'll get back to this price action.
I believe Mr. Bezos will be having Tang in space.
He will have Tang. Can you confirm? You're making something
Tang
up
this
again?
morning is very
Tom,
good.
I've told you repeatedly, we've worked together a long, long time. People can't tell the difference between when you're telling the truth and when you're making stuff up. You've got to be careful.
It's serious. I mean, come on. I mean, you know, Bezos drank Tang as a kid, and I'm sure he's going to be up in space. I can't even say it with this.
Do you want to get back to this bond market?
Why don't we get back to the bond market? Subrata Rajapa's with us with SocGen, and this is the interview of the day, folks, on fixed income. I'm sorry, Subrata, we were going on Tang there. Subrata, what is driving the low yield? Is it the pricing in of global slowdown?
Yeah, no, I think that this feels like a classic flight to quality, if you will. 10 yields, at least the last 10 to 15 basis points, have been reacting more to news flow and safe haven bid, risks associated with the Delta variant, lower crude oil prices, and general concern, if you will, on global economies, and not so much on fundamentals. I mean, the data has been sort of back and forth. We got somewhat okay retail sales numbers. CPI was above consensus. But the markets, right now seems to be more of a safe haven bid than anything else.
But is this textbook Fibonacci where what we're really doing is pricing in the input of global disinflation, even if the U.S. booms, even if the U.S. does better, even if strategists call for higher yields, the fact is we impute global disinflation into America, and that suppresses yields.
Oh, absolutely. I think that it's a global bond market, if you will. The ECB has been very dovish. We get some forward guidance again on this week's ECB meeting on Thursday. I think everybody's going to be paying attention to all the details, but they're going to broadly remain dovish, and bond yields are at close to negative 40 basis points. I think that lower global bond yields are another factor that's going to keep U.S. bond yields lower, and also the CPI, or the inflation differential, if you will, between U.S. and Europe is quite dramatic. So I think that as long as inflation remains contained overseas, you're going to see that global bond yields are going to remain low.
And John, look at the 10-year yield. For those of you on radio, I mean, it's a decline, John, and then it's a real collapse in yield.
123 right now, very briefly, breaking below that. We're down 6 basis points on a U.S. 10-year. So, Bandra, you just mentioned something quite important. The inflation dynamics in America is a very, very different story to what we're experiencing right now in Europe and elsewhere. Why is that important for this bond market in the US, in the Treasury market?
Well, because of the yield differential between Treasuries and bonds and Treasuries and JGBs. Because the way the global bond market trades, you can buy assets in other currencies very easily. And as long as Treasuries remain attractive on a currency-adjusted basis, you're going to see this demand coming from foreign investors. That's not exactly what's driving this price action here. This seems to be much more driven by a safe haven bid, if you will, for Treasuries. But broadly speaking, as long as those yield differentials are wide, you're going to see, at least Treasuries are going to struggle to rise. Treasury yields, are going to struggle to rise based on fundamentals.
So, Badra, I don't envy you right now. I think you're in a really tough spot in this bond market. And I just wonder, can you give us some insight into what your conversations with colleagues and clients sound like right now? The level of confusion, the degree of confusion about what is taking place here in this bond market at the moment?
Well, there's definitely a decent amount of confusion, right? This is a completely out of consensus move, if you will, in Treasuries. The expectation, broadly speaking, was for a gradual rise in yields in the second half. And now we've basically reversed all the losses we've seen, at least a good portion of it, in the last quarter that we saw from the beginning of the year. We saw a dramatic sell-off between January and March, and now it's starting to reverse those gains. So, and the flattening of the curve is also not a consensus view. So I think that we're all kind of trying to figure out where things go from here. I feel like the bond market is in a limbo. We're waiting on a whole bunch of other factors to come into play for fundamentals to improve and for Treasury yields to rise.
What other factors, Subhadra? Because if it's not hot inflation, for instance, if it's not hawkish commentary coming out of the Federal Reserve, what is the catalyst that makes yields go higher?
I think employment is key. I mean, we saw some data that last month's employment print was quite strong. I think that the Fed feels like they've reached their substantial further progress mandate on inflation. Really, the concern now is on the employment front, and we need to see anywhere between 500,000 to 1 million jobs being created for the remainder of the year. And that, I think, is going to be the key for both policy as well as for Treasury yields moving higher.
Consensus has totally broken down. Subhadra, it's good to catch up. Subhadra Japa there, Societe Generale, head of US rate strategy. Let's get you up to speed on radio, on TV for our audience worldwide. Your bond market is bid. Very, very firm. Yields are lower by 6 basis points. The low at a session, 122.69. The lows right now, 123.02. That's where we're priced at the moment. Your bond market, strong. Yields lower. Your equity market, soft. Equities lower. We're down 46. We're off by 1.08% on the S&P 500. Down about 47 points now. NASDAQ 100. It's part of the story, part of the gap lower as well, Tom. If you think about it more recently, what's held up? It's been the NASDAQ 100. Into last week. Then last week it was everything lower. The S&P, the NASDAQ, and the Russell too.
Yeah, I would go with that, John. We're going to go into earnings on that. It is hugely discrete to big tech, and you see that again with an 8% pullback in the Russell 2000. You know, John, I look at it, and what I see in the research tone over the weekend and to begin the week is the loneliness of the United States with that massive fiscal stimulus. I'm not speaking of that is a compartmentalized United States, but just the separateness of it from the other dynamics out there.
Well, Q1 was U.S. exceptionalism, Tom. How many times did we talk about that? What's Q3? What would you call Q3 right now? Because people started to question the continuation of those themes. I think there's total confusion at the moment as to what is going on.
Well, I agree with that. The VIX is out 3 big figures. We're going to be negative 500 in the Dow here in a bit. We're not quite there yet.
Tom Keene, Kailey Leinz, Jonathan Ferro, Lisa back next week. Your bond market,
So
123. She'll be back, Tom. If the market's like this, no doubt about it, Lisa comes back. She'll be missing this, Tom. Equity's down 47. We're negative 1.1%.
Kailey's not gloomy, though.
She's not. Well, that's what I mean for Lisa, Tom. She'll be missing this kind of price action. I'm sure she'll write in any moment. 42.70 on the S&P 500. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. OPEC and its allies have overcome an internal split that threatened its control of the oil market. They reached an agreement to inject another 400,000 barrels of crude a day into the global economy. Saudi Arabia met the United Arab Emirates halfway in its demand for a more generous limit on output. Now, the American father and son team that smuggled former Nissan chairman Carlos Ghosn out of Japan are going to prison. A Japanese court sentenced Michael Taylor to 2 years. His son, Peter Taylor, received a 20-month sentence. They pleaded guilty to aiding Ghosn's escape to Beirut. Senate Majority Leader Chuck Schumer has set up 2 major tests for himself and Democrats this week. Schumer's hoping to have a first test vote on the bipartisan infrastructure bill this Wednesday. This is the same day he wants all Senate Democrats to get behind a much bigger spending bill that would carry out the bulk of President Biden's agenda. And finally, in golf, American Colin Morikawa has entered the record books with his victory in the British Open at Royal St. George's. The 24-year-old came from behind to win the title by 2 shots over fellow American Jordan Spieth. No other golfer has won 2 different majors in his first attempts. Last year, Morikawa won the PGA Championship, and that was in his debut. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The 400,000 barrels a day put into the market will turn out to be a pittance, and we'll see prices going back a bit higher, if not a lot higher, by the time the summer is over.
That was Ed Morse of Citigroup. We have an OPEC Plus deal. That is not where the attention is right now. Let's be clear about that. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Kailey Leinz with us today. Lisa back with us next week. 42.71 on the S&P, down more than 1 full percentage point now. But it's the bond market that just keeps getting everybody's attention. 122.69 on 10s. I'll repeat it if you're just tuning in and wondering what the hell I'm talking about. 122.69 on 10s. We're down 6 basis points. Low to the session, 122.53. We're just off them, Tom. 122 handle on a U.S. 10-year.
This is the nominal yield moving quicker. I'm looking at inflation expectations and the residual, which is the real yield, John. And this is about the nominal yield. John, I've got to say it again. The timing of that with the Bloomberg article of significant Chinese-U.S. tension, maybe that's a further catalyst.
You think that's contributing to this, Tom?
I think that's the right word. I'm hesitant to say it is because of it, no. But I'm saying it's in the mix this morning. The political tension there is tangible.
Certainly a continuation of the theme that we've seen over the last couple of months of yields lower. The 30-year too. The 30-year is at 184. At the end of March, the 10-year was at 177.
Right.
Tom, just think about that, just to get your head around where yields were and where they are right now. We've gone from 177 on 10s all the way down to 122 on 10s right now. And the outlook for many people, we haven't mentioned this yet, have we? It's the peak everything theme. that people keep leaning on. They keep going back to, Tom, peak everything. We've moved past peak everything, peak fiscal, peak monetary policy, peak growth, all of the above.
I have trouble coming up with a theme right here. We're going to have a theme, and maybe it'll be earnings as well. Let's do this. Let's theme over to what John has mentioned a couple times this morning, which is the Russell 2000 can't get out of its way. David Wilson notes this. David, what do you have?
Yeah, we've had quite the reversal in the last few months, and it's something that Charlie Bolello over at Compound Capital Advisors pointed out the other day, looking specifically at exchange-traded funds. I went to the underlying indexes. You saw the Russell 2000 move up 44% relative to the S&P 500 in the space of about a year, peaked in March, and since then, it's given back more than half the advance. We're really back to where we were 2018, 2019, into 2020, with the larger companies ruling the roost. So it's the S&P 500, again, showing relative strength.
It's relative strength, but it's relative strength compared to the last time they had relative strength, or is it just a reaction? Is it for real?
Well, I mean, you've had a lot of back and forth lately, and we've seen, a whole number of changes. I mean, think about, a few months ago, we were talking about the cyclical stocks, the ones most affected by economic growth, kind of leading the way. We've seen a swing back toward the big tech companies, the ones that were leading the market for years. And so you could argue that what you're seeing with the Russell and the S&P 500 is kind of indicative of bigger shifts going on in the market at this point.
I look at this, David, one more question, just we've got to get back to the markets and the dynamic as well. You are the guy on earnings. Folks, there's a point where David Wilson has like 40 companies to report on in a 20-minute period, and only he can do that. What are you steeling yourself for with earnings season?
Well, the real question, and it's already emerging, is how are people going to take the results, even if they're great relative to estimates? And now, you've got more than 70% earnings growth for the S&P 500 built into analyst estimates for the second quarter. That's according to our numbers that we've compiled. So it becomes a question of, are we going to see, and we've already started to see it, is it going to be a case where people look at the numbers, say, they're all right, and then they don't really react in terms of the shares. Or worse, they move things down because they don't like the outlook.
David Wilson, thank you so much. Got to get back to the markets right now, of course, with wonderful charts. See them with his work on the Bloomberg terminal. John Farrow, the 122.69 10-year, right at the precipice.
122.53, the lows of the day, Tom. 122.69 right now. You mentioned the earnings, and we've talked about this repeatedly over the last couple of weeks. Those earning calls, the tone of them, they're going to sound radically different compared to what we'll hear from market participants, for inflation expectations, for corporates right now, Tom, for the
C-suite, has got to be spinning.
Who are putting wages up and wondering about the cost base through the future beyond this year, and then for the bond market that's staring down the barrel of 122 on a U.S. 10-year. It's like two different worlds.
Well, we're three different worlds. I mean, it's like an alternative universe. I mean, John, to me, it's extraordinary what we're seeing. And right now, this is where the Bloomberg terminal folks really comes in. It's not about one statistic or two statistics. John and I are watching 5, 6, 7, 8 statistics on the screen. John, one proxy for me is a sterling that's going to give me a 136. I mean, that's a heck of a move from Johnson optimism of a number of months ago.
Dollar strength, the theme here through G10.
Yeah.
The loonie, the Canadian dollar, negative 1.3%. The only outperformer in G10 right now is some Japanese yen strength. Yen strength of 0.4%. Morgan Stanley have called this a rolling correction. This rolling correction. And it was small caps the middle of March. That's where they topped out. And they were aggressively lower last week. Dev Wilson right to bring it up, a 5 percentage point move. But within the equity market this morning, travel stocks over in Europe. Kelly, I keep going to this. Travel stocks over in Europe, hammered. In the US, the airlines down more than 20% from the highs earlier this year. This is not the point people thought we would be in 12 months ago, 12 months looking out. A lot of people thought the travel situation, international travel, would be in a much, much better position.
A lot of things aren't the point where we thought we would be, John. You're talking a lot about how consensus calls have just been wrong. All of these consensus trades have been breaking down. That is true for the small cap over large cap trade. That is also true broadly for the reflation trade. Even this morning, I'm looking at some of the pre-market action in the ETFs that track sectors. The energy select sector, Spider, down 3%. The financials under some pressure as well. And of course, it all comes back to that yield story, down 6 basis points on the 10-year. Where is my reflation trade, Tom?
John, she's quoting ETFs on surveillance. Do we do
That's
that?
allowed. We can let that happen.
Really?
Mention the financials. Let's pick on the banks. The banks are down almost 10% from the highs back at the beginning of June. Now, for a lot of people, Tom, who are along this sector, they've done terrifically well, tremendously well year to date. But more recently, can you really have any confidence about that trade working over 10 years at 122?
Well, it's a spread market.
122.69.
210 spreads a 101, and it's deteriorating. And just as a rule of thumb, how do the banks do it in their traditional business with a 0.99 210 spread? That's an original idea. John, the VIX just now out to 3 big figures.
You mentioned a 210 curve, Tom, threatening to break 100 basis points. Right now, 101.5. So just what has gone on here in the last couple of months? The level of confusion, the degree of confusion. Last week we joked about the C word, a dirty word, consensus. I don't think there is any consensus on this bond market at the moment, Tom. I think the people who believe that we can get back to 2 don't really have the confidence or conviction to do anything about it right now in this moment with a market that looks like this.
We don't do this on Mondays, John, but yield dynamics are basically 4 factors, as Kailey just mentioned, factors in the equity market. And the real emphasis this morning is on the inflation-adjusted yield as being one of those factors. You know, there's going to be a lot of work. Ira Jersey and other bond experts are going to have to weigh in on the character of this price up in bonds.
We've got to talk about this bond market. We'll do that with Tony Rodriguez, Nuveen Head of Fixed Income Strategy. We will do that next. Your equity market down 47 on the S&P to 42.71, negative 1.1% on the S&P 500. Yields lower 6 basis points to 122.86 on 10s. Heard on radio, seen on TV. This is Bloomberg.
We may once again be surprised in the second quarter to see earnings being much stronger than maybe we might have thought.
You're going to see the economy move into a position of excess demand.
I think we have seen the peak in rates probably for the cycle. There could be another twin peak later on.
We think that the Fed is correct, right? That inflation is transitory.
If you do get this sort of sense from the Federal Reserve towards August, September, that they're looking towards tapering their asset purchases, a lot of traders are going to be caught off guard.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. Abramowitz off on 14 weeks of vacation. Kailey Leinz helping out this morning as well. John, it is a summer of discontent. There's any number of reasons, but we observe on the Bloomberg terminal the tension of a July Monday.
It is not the summer people anticipated, though, Tom. People were talking about tapering and higher yields on 10-year treasuries. This is not a taper tantrum. If it's a tantrum, it's because yields are lower, much lower than people anticipated. Down 6 basis points, 122.86 on 10s. Lows of the day, Tom.
Yeah.
122.53.
John, let's fold in the data check right here because we do have markets on the move. We'll give you more data checks on radio and TV through this hour. And this morning as well, I believe John Farrell has his property, the opening. Look for that at 9 a.m. John, to me, it's about the combination of gold down $17, under $1,800, $17.97 an ounce, all the dynamics of the bond market, and it screams to me a global slowdown.
Yields lower 6 basis points to 123 on 10s. Your equity market lower 42.74 on the S&P 500. Equities down by a little more than 1%. Your dollar stronger. Dollar index getting back towards that 93 level on the dollar index. 117.68 on euro dollar, down a third of 1% there. Got the OPEC Plus deal in the mix. That's taking crude south of 70, $69.05. Here's the story for me, though. At an individual stock level, Tom, switch up the board and get to the airlines. It has been tough. Over the last year, we're still up more than 50% on this sector, this industry group on the S&P 500. Let's be clear about that. But more recently, it's been difficult. Again, in the pre-market, Delta down by 3.6, American down by more than 4%, United down by more than 4.5%. There is a travel factor in all of this. The Delta variant is a factor in some of the trading that you're seeing, and you're seeing that isolated in travel leisure. More recently, you wonder if that's going to start to bleed out to the broader market. Right now, Tom, I'm focused on the banks. If we can just have a look at the financials pre-market, it is tough to make the banks trade work with a 2's10 curve threatening to break below 100 basis points. Let's be clear about that. JP down 2%. Bank of America down 3. Citigroup, Tom, down by 2.53%.
Kailey Leinz, what do you see on the Delta variant? What's your reading over the weekend? You're reporting this morning on the new tone of this pandemic.
Well, it's interesting, Tom, because on the one hand, the numbers would tell you things are getting worse, at least when it comes to cases. Look at the UK, for example, north of 50,000 new cases reported on Saturday, but it's not necessarily following through into hospitalizations and deaths. Of course, that is where the vaccine comes in. People may be testing positive, but they aren't getting as sick. So what does the policymaker respond to that if people aren't actually getting sick and dying? Of course, Joe Biden over the weekend essentially saying there is still a pandemic, Tom. It's just within the unvaccinated population. So there is still a very stark divide between those who have and have not gotten their shots. And the pandemic looks very different for each of those groups.
John, before we get to our esteemed guests here on fixed income and how it folds into global dynamics, John, I've got to look at a European week here. I've got German yields enjoying what the U.S. is seeing. The Swiss 20-year, which is my personal benchmark there, now negative 0.10 points. The challenges of Lagarde are tangible.
I think they are too. If we get a dovish news conference, Tom, a dovish decision, does that lead to higher or lower yields? I think that's going to be really interesting. HSBC out with the research this morning. Their call, a commitment from the ECB to leave rates unchanged, no rate hike until the end of 2023. This idea, and I keep going back to this line that President Draghi used many years ago, rates have to be low now to be higher in the future. That's not quite working out for this bond market at the moment, Tom. It used to be a dovish Federal Reserve would lead to higher interest rates. That was the Q1 story. Right now, we're talking about tapering, yields go lower. You talk about a dovish Fed, yields go lower. Hot CPI, hot PPI, yields go lower. I don't think anyone really knows what's going on, Tom. You can ask 4 experts on Wall Street about the bond market right now. You'll get 4 different opinions.
Let's get a fifth one right now. Anthony Rodriguez joining us with Nuveen, head of fixed income. And what is so important about Tony Rodriguez is he is steeped on the other side of the bond market, which is the demand and the supply coming on across full faith and credit, IG, and high yield as well. Tony, what is that robust search for yield you write about? There is a massive demand for yield. How is it quenched, if you will, given the movement we see in full faith and credit this morning?
Well, good morning, Tom. Good to be with you. I think you're right. It's difficult to quench that thirst for yield given the very low level of Treasury yields. Now we're getting threatening 120 here this morning. But the really important point, I think, is that the search for yield is going to continue to be a very, very strong support for the broader fixed income markets. And one of the main drivers of why we have these low rates in the search for yield is the incredible amount of liquidity that's being supplied to the market, not only by the Fed, but by the ECB, as you were just talking about with their strategy review this week. We're seeing it from the BOJ. There's just a tremendous amount of global liquidity that is keeping broader sovereign yields at levels which force investors to search for that yield. And a lot of that leads them into some of the U.S. credit markets, for example, emerging markets, et cetera.
Until recently, Tony, yields have been lower, equity markets at all-time highs, credit spreads tight, absolute yields incredibly low. Until recently. Last week, things started to change just a little bit. Can you walk me through those cracks that you might be seeing at the moment?
Yeah, hi, Jonathan. I would say that the things that you're seeing right now is there's a little bit of concern on the growth picture. So we've seen some data that's a bit mixed. You've seen a little bit of mixed data out of China, for example. Number 2, there's a little bit more thought process amongst investors that maybe the Fed won't be as dovish as they thought, whether it was from the June meeting, moving up their dots, whether it's in some of the Powell testimony, talking about their willingness to respond if inflation unexpectedly is more persistent than they currently think. I think people are factoring in a potentially more hawkish Fed than what was priced in before, which has obviously led to that technical unwinding that we saw from both Treasury short positioning and curve flattening positioning. So the Delta variant is part of that growth risk story as well. And now lastly today, throw on top kind of an increase in the geopolitical tensions between China and the U.S., that all leads to a little bit of a risk-off positioning, I think, in the broader market.
So do you need to rethink a call of a 195 on the 10-year at year end?
Hi, Kailey. That's a great question. And I remember being back on the show back in March, and we were trying to convince investors when we were sitting at 1 3/4 why we weren't going to 3% on a 10-year. Now we're back to a 1.20, and we're trying to convince investors why we're not going to revisit sub 1%. So we think you will see that the inflation story is a bit transitory, whether it's used car prices or lodging, that will reverse. And so the fear of a Fed having to be hawkish prematurely and tighten early, I think will start to recede, whereas you're still going to have a healthy consumer. We still think you're going to see pretty solid growth in the second half. And that, I think, will pressure yields back up towards the top of the range. The broader story, though, of lower rates for longer, and that we're not going to see that 3% 10-year for various, long-term reasons around disinflationary forces, high levels of debt, low productivity, that story, I think, remains in place. So the upside to yields, while we do think we get back closer to 2% by the end of the year, we're not going to see ourselves much higher than that over the course of 22.
Tony, let's talk about the story, the narrative. There's always a story about the price action, whether it's technical or fundamental. You know how this works. And right now, I think some of those stories are in pieces, and people are looking around and trying to put one together again. And that's always the risk, isn't it? That moves like this can take a life of their own. Price first, narrative second. Mohamed Al-Erin out on Twitter this morning saying if this continues, the narrative will shift to stagflation. That would be a bigger worry for markets. Tony, can you speak to that, the risk that this takes on a life of its own?
I think it's a great point, Jonathan. Right now, 121, 122 is a pretty key technical level. Below that, you can get all the way down to 105. And obviously, the narrative to that is very much about disinflation and back to really the last decade plus of central banks trying to generate inflationary pressures and being unable to do that, whether it was in Japan, Europe, or the U.S. So I do think that disinflation, stagflation would be a bigger risk for broader capital markets, both risk markets and fixed income and the equity market. And that's part and parcel why the global central banks, in our minds, are going to continue to be uber dovish. And you'll see that beginning this week with, I think, what will be a fairly dovish outcome from the ECB strategy review.
ECB this Thursday. Looking forward to that in a way that I was not a couple of weeks ago. Tony, thank you. Tony Rodriguez, Nuveen, Head of Fixed Income Strategy. Here's your setup on radio and TV for our audience worldwide. This is the situation at the moment in your equity market. The S&P down 50. The S&P 500 negative 1.16%. Outside of that in the bond market, we are off the lows just. We're down 6 basis points on 10s to 122.69. And I've got to be honest, Tom, if someone asked me this morning, John, what is going on in the bond market? I'd be honest with them. I have not got a clue what's been going on in the bond market for the last couple of weeks, and I don't think many other people have either. This has taken a lot of people by surprise.
Taken them by surprise, but in the last couple of days, John, I do think it's about this set of things, a global scare. We've got the new Delta variant worries as well. Thank you, Joshua Sharfstein, for a brief on that. But, John, as well, it's just a question of how the U.S. moves to the next stimulus. It's not there. John, I had a negative 500 on the Dow moments ago.
Thank you for the update on the Dow, TK.
It's good, important to have
the
that.
NASDAQ 100 also softer this morning. We're deeply
but
negative
the Dow
there
is
too.
more gloomy. It's
Thank
a pendulum of Dow gloom.
Is that what we're trying to do here? Establish some gloom?
Yes.
Without Lisa here.
Yes,
42.70 on the S&P 500, negative a little more than 1%. This Monday morning, good morning. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. For the first time, NATO is calling out China for cyber attacks. The US, the UK and their allies have formally blamed the Microsoft Exchange cyber attack earlier this year on hackers affiliated with the Chinese government. British Foreign Secretary Dominic Raab says that Beijing will be held to account if it does not end this, quote, systematic cyber sabotage. Now, OPEC and its allies have reached a deal to inject more oil into the global economy. They have overcome a split that threatened the cartel's control of the market. Saudi Arabia met the United Arab Emirates halfway in its demand for a more generous output limit. The OPEC Plus coalition will start pumping more oil. That's next month. Prime Minister Boris Johnson's plan to get the UK back to normal is in disarray. Pandemic restrictions are ending here in England today, but COVID cases are rising more than any other country in the world. There were almost 48,000 new cases investors reported yesterday. Plus, Boris Johnson and Chancellor Rishi Sunak had to reverse a decision after first refusing to self-isolate, despite being told to do so by the NHS. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Summers are a difficult period for the market, and what we're kind of setting up for right now is to get to August, have interest rates pretty low, and have the Fed come in and shock the market with their taper announcement. So, I think, this is going to be a transition year.
It is a difficult morning for the equity bulls. It was Robert Tipp there, PGIM Fixed Income Chief Investment Strategist and Head of Global Bonds. Your global bond market looks like this morning. Good morning. Live from New York on radio and TV. Yields in 6 basis points. Call it 7 if you want to round it down. We're negative 1.2236%. Not negative 1.2236%, but negative yields, Tom. We're down to a positive real yield of 1.2236%. Over in Germany, we do have a negative nominal yield, deeply negative about 1/3 of 1%. And we were talking about maybe getting back to zero. That feels like months ago. Outside of the bond market, in the equity market, down 53 on the S&P 500, negative 1.24%. Looking at the lows of the session now at 42.65, 1 hour and 12 minutes away from the opening bell. Dollar stronger, euro dollar 117.65, down 1/3 of 1%. Have you changed your view for the rest of the year? Michael Purvis of Tallback and has, Tom, except not in the way that you might expect. He's going out to 4,800 on the S&P 500.
Love it.
Moving higher from 4,200, was it, out to 48 year end over at Tallback.
It's a double-digit move. Good morning, Ben Laidler in London as well. And folks, this is always a joy within the blur and the privilege we have of all of these intellects. John Farrow, to look at the gloom on the screen right now. For the first time, John, I'm on a 0.99 210 spread watch. All you need to know, massive curve flattening this morning out to new 210 flatness. And there's Purvis with a pendulum of optimism.
From 4250 to 4800. And Kailey Leinz, when you read through the note, again and again and again, one word jumps out: earnings. Earnings. Michael Purvis on better earnings to get you to 4,800.
Yeah, this idea that even if we are peaking in the second quarter, the slowdown in growth, that second derivative, isn't actually going to be a problem. People aren't going to sell equities because of that. And I also find this notion that he mentions that because the reopening has been stunted a bit, whether it's supply chain issues or the fact that there are still concerns related to variants in COVID-19, some of the growth from 2021 is actually going to extend into 2022, 2023, effectively be deferred, which I think is an interesting notion, Tom.
Very good. Let us do this. Let's sum it where we are right now, and we can do that with Cameron Kreis. He has 3 logins on his terminal and 12 screens and joins us this morning. Cameron, you talk about a sum of our risk aversion. Describe our risk aversion on this fractious Monday.
Well, it seems to be a COVID thing, which is, I'm a little hesitant to say because it's such a convenient scapegoat. I think it seems like for most of this year, whenever the stock market goes down a day, people say, oh, well, people are worried about COVID. But, and then the next day it bounces back. But this time seems a little different. You've got a confluence of a number of factors. Clearly the focus in the UK has been on so-called Freedom Day, the relaxation of all the restrictions, at the same time that cases are shooting higher. Possibly because of everyone going down the pub and watching the football, the European Championships. So that's not a very pleasant, situation. And if you look under the surface at the performance of equities here in the United States and indeed more globally, kind of a familiar theme rears its head. All the industries that were terrible last year during the pandemic have suddenly turned terrible again. We've got this sort of narrative that we've got this great reopening, and it's true, and life for me and perhaps you guys seems pretty normal.
It's okay.
But if you look at what's going on with the stock price of airlines and cruise lines and hotels, they're kind of look pretty terrible. So that would certainly seem to be pricing some sort of reversal of all this reopening stuff. And if you think that reopening is going to have to fade, which is what these markets are telling you, and all of a sudden that price action in the 10-year seems a lot more reasonable.
2s10s threatening to break 100 basis points this morning, just north of that right now. This has been developing for a while, Cameron. We topped out on nominal yields on a yield curve as well at the end of March. The airlines breaking down is not particularly new either. The banks breaking down, they peaked at the start of June. We're down about 10% there too. When I'm thinking about what's new, it's very, very recent. It's just the broad index starting to come with it, and only by a little bit as well. Cameron, when you think about the what's new of it in terms of this correction in this market, how important is that?
Well, I think the issue as we enter into earnings season is this, this sort of inflation dynamic, which, the Fed is very easy to say, oh, it's transitory and what have you. But real companies are facing real pressure. And the, sort of the downside risk, I think, when it's been alluded to by a couple of the early reporters, is margin compression. There is some capacity to pass on higher input costs to end users, but to some extent, some of these companies are going to have to be absorbing the cost, the higher input cost, and that's going to be a hit to the bottom line.
Yeah.
And that's something that perhaps hasn't been appreciated enough.
To that point, Cameron, the word inflation was mentioned on 87% of earnings conference calls in S&P 500 companies this month. That's up from 33% in the same period a year ago. So clearly something companies are worrying about. And as we talk about this earnings season, do you expect that it will give fresh impetus to the value trade that seems to have fallen out of favor, or is it going to give growth just another leg higher?
Well, I mean, there's certainly the possibility that the answer is neither, and that everything is kind of priced to something approaching perfection, and that there has to be some sort of, if not comeuppance, then at least perhaps a small repricing to reflect that we're maybe not living in the best of all possible earnings world. I mean, sometimes it's not an either or. It's both or it's neither. And I mean, frankly, for much of this year, it was both. I mean, yes, value was outperforming growth, small caps were outperforming large caps, but kind of everyone made everything went up, just varying degrees. There is a possibility that everything could go down just in varying degrees, if only temporarily.
Well, it is right now. The equity market, the S&P down 51, we're negative 1.2%. Cameron, it's been way too long. Cameron Christ there of Bloomberg. I reached out to Michael Purvis of Tallback, and he goes from 4,250 to 4,800. He responds in a nutshell. He says, Tom, the bond move is not an indictment of growth over the next 2 or 3 years as much as it is a reflection of Fed policy and foreign yields. Lower bond yields mean a healthier equity risk premium, which affords more dip buying prospectively. That's the quote just now from Michael Purvis emailing me back on the why, Tom. The why.
Yeah, the why, I like that. And he's picking it up on the idea of traditional equity analysis over to what we're going to see with earnings growth here in a boom economy. Granted, it may slow down. But, John, what's really important here is Purvis picks up on the tone of Kailey Leinz, which is it's different. It's the pendulum of optimism.
The pendulum of optimism.
We've picked that up.
We should have Kailey and Lisa do a special. Like a bull bear special or something, Tom.
Should we mention our space coverage tomorrow? It's important. Kailey Leinz will have Tang overnight. She's never quaffed a Tang.
You won't, Kailey.
It'll be part of our Blue Origin coverage.
8:30 Eastern, that begins as Jeff Bezos sends himself into space. You excited for that, Tom? From New York.
Fascinating.
On radio.
11-minute flight.
On TV. This is Bloomberg.
That's about...
Live from New York for our audience worldwide on TV and radio. Let's get you your Monday morning price action. If you are bullish, cover your ears, cover your eyes. We're down 51 on the S&P. We're negative 1.2%. It's not that dramatic, is it? But you might be on the wrong side of it in the bond market. Yields are lower by 7 basis points. 121 handle on 10s. There we go, Tom. 121 86, this 10-year breaking down and breaking down quickly. And it comes with some dollar strength. Euro dollar 117.71, negative a third of 1%. This is a real risk-off moment. This is what it looks like. Yields are lower, dollars stronger, equities are lower, and crude softer. There's an OPEC Plus deal in the mix too. Be mindful of that. 69.19 right now, Tom, on WCI.
It is interesting, and we could spend the morning on the data check. John, we've got to be on the watch on 2's10 spread. I mean, it's a 0.99XX there out to 4 decimal points is a huge deal. We're not there yet.
101 at the moment, Tom.
Yeah, we're not there yet. Well, let's get it going. What I want to do right now, Megan Green, Harvard Kennedy School with us, of course, where they're working market economics and academics as well. And out with a book, the movie rights have been sold. We're waiting for her book on theory and reality of our economics. Megan Green, can you explain the theory and reality of this summer of 2021? The three of us wait with bated breath.
Yeah, well, I mean, what I'm looking at is everything in economics that doesn't really work anymore. And there are a number of examples. But one I think that's particularly relevant right now is sort of how inflation works, because, of course, that's what everybody is talking about in economics at the moment. And I think if you're an old school economist, you look at the output gap that we're trying to fill with the stimulus, and your hair is on fire because we're overfilling it, and you worry about overheating the economy and generating significant inflation. We are seeing significant inflation. That was predictable and predicted. The question is, will it last? And I think if you think about the world as a more complex system with multiple equilibria, not just a single potential growth rate that we should be aiming for, then the point of filling the output gap, it's a little bit irrelevant. Instead, policy's role is to fundamentally prevent scarring from lasting, prevent us from dropping to a lower equilibrium, or boost us up to a higher equilibrium. And then you're just not that worried about inflation. We might have some now. You consider that's more supply side constraints that should be worked out over time.
Your work at Harvard and the foundation of microeconomics is the ambiguity that we're presented with every idea can cut this way or that way. What do you do with the ambiguity of a boom U.S. economy and a much slower global economy? How does that ambiguity cut in 2022?
Well, I think everything, first of all, will be driven by the virus, as it has been for the past year and a half. And so therein lies the ambiguity, I think. If a new variant continues to drag on global growth, if vaccination across most of emerging markets remains slow, that'll be a drag for growth for the U.S. as well. So I think this is why investors are starting to consider that we're past peak growth, because if the domestic economy is firing, but the global economy is still sluggish, then that's going to drag. So I think that's the main component.
Megan, we had a read of consumer confidence in America on Friday, and Lisa last week was pointing out how important it is to look out for that. So shout out to Lisa as she enjoys her second vacation in the space of a month. We'll talk about that later, Tom. And Megan, she talked about how ultimately higher prices could weigh on confidence. Are we starting to see that happen in America?
I don't think we're actually there yet. If you look at the University of Michigan survey for inflation expectations, for example, 1 year out, they're pretty high, but they come back down in the medium to long term. So, and that's what anchors inflation expectations is medium term inflation expectations. So I don't think we're seeing that yet. But if this were to last for, another year, for example, and no one's really defined what transitory is, least of all the Fed, it could last for a while longer, then it could start to impinge on consumer confidence.
One thing the Fed did tell us earlier this year when yields were spiking into the end of March, that it was a vote of confidence, a validation of a better outlook. That was because real yields were blasting upwards. Now they've come all the way back in again, Megan. And I wonder how the Federal Reserve would characterize this move in yields that we're seeing at the moment.
Well, I think they're viewing it as a opinion on growth. I know you just had a guest on who disagreed with that, but I do think the idea that the variant, actually the Delta variant, is causing a spike in cases. There are real concerns about parts of the world that are not vaccinated yet. I do think that's a big driver of the yield curve flattening. Also, I think there are concerns about inflation a little bit at the short end. That's what's driving the short end up.
Megan, I was asking Subhadra Rajappa of SocGen earlier, what is it going to be that then is a catalyst for higher yields? And because it's not been hot inflation prints, it's not been the commentary out of the Federal Reserve, and she said really it's going to all be about the labor market. Is that the only data that matters right now?
I don't think it's the only data that matters. I think if you had inflation actually sustained for a significant period of time, and I don't sit in that camp, that could also cause concerns about long-term debt sustainability that could push the yield curve up as well.
Tying together inflation and the labor market then, what about wages? Do you expect any kind of wage pressure to materialize in the coming months?
Look, I think there are a whole bunch of structural drivers in the economy that have kept upward pressure off of wages, including things like digitalization, market concentration, globalization, and none of those things have gone away. In fact, most of them have just been accelerated during this crisis. So, I think in addition to the fact that we're adding a bunch of service workers to the labor force, and they tend to be low-hour, low-wage jobs, that will keep upward pressure off of wage growth in the short term. But there are all these structural drivers that I think will offset any significant wage price spiral. And if you don't have a wage spiral, it's really hard to have an inflation spiral. In fact, it's pretty impossible.
Megan, John mentioned this, I think it was 2 hours ago, deep into our day. And it's just simple. Are we just moving the timeline, the x-axis on monetary policy out? John, I believe, correct me, John, did you mention 2023?
HSBC out with a call, Tom, looking for the ECB maybe to change that guidance to no rate hikes until year-end 23.
Is that what we're doing, Megan? Is that where we are right now? Can we even get to 2024? Megan, I got to make some news here. The Red Sox, I'm worried. Help me here. 2024?
I'm a little worried about the Red Sox, too. Look, the inflation outlook in Europe is completely different from what it is in the U.S. Inflation has been persistently low for a longer time in Europe, even more persistently low, at least. And even though the ECB's changed their monetary policy strategy to no longer include an asymmetric bias in their targets, so they're willing now to overshoot on inflation, they have no credibility in terms of actually being able to achieve inflation of over 2%. And so I do think it's appropriate for the ECB to be easing longer than everyone else. The ECB is increasingly finding itself in a lonely corner, though, as every other major central bank is starting to talk about withdrawing accommodation. The ECB is stuck in there for quite a while. I think they'll probably end their PEP bond buying program in March of next year as planned. And then they're going to have to figure out how to revamp their old asset purchase program, because don't forget, Greece isn't actually eligible under it. And that would be a huge blow for Greece. So I think there will be some tweaks, not just for Greece, but also to increase it for other countries as well.
Megan, I've really struggled with that ECB news conference over the last year, as many other people have done as well. Do you think this one could actually be interesting this Thursday?
No, I'm sorry to dash your hopes, John. I don't actually think it will be that interesting. I mean, what the ECB has done is to effectively bake into their official mandate what they'd already said that they were going to do. There are other interesting things about tweaks that they've made to the monetary policy strategy, particularly around climate change and how they'll consider climate change in monetary policy, not just in regulation and their oversights, but we don't have many details on that, and I don't think we'll get many details on that for some time. I think the most that we'll get is sort of how forward guidance is going to go for the ECB. But the main message that we all know is coming is that the ECB is going to need to see, the whites of inflation's eyes before they're willing to actually withdraw accommodation, and they've kind of been saying that already. It's just official now.
The ECB, from its monetary policy perspective, has been dealing with a very different fiscal equation than the Fed is dealing with here in the U.S., and that in Europe it was much smaller, here in the U.S. very large, and it just keeps coming. In theory, we could be getting trillions more in long-term economic spending. How are you viewing that in terms of whether or not it's going to lead to an overheating of the U.S. economy?
So of the U.S. economy, we don't know what we're going to get yet, for starters. So we'll see what lands on the cutting room floor. But we should get significant fiscal stimulus in the U.S. coming down the pike. A lot of that will go towards productive investment, productive public investment. And so that should fundamentally boost the economy to a higher level. And so I think that's absolutely positive. All of the infrastructure spending and also investment in human capital, that's all aimed at fundamentally boosting the U.S. economy to a higher potential growth. And it's meant to be released over a number of years, so it's not like we'll get all this spending in the next year. We'll probably take just under a decade to release all of this spending. So it should continue to boost the economy. I don't think we need to worry about overheating, because I think the output gap is kind of an antiquated notion. And like I said, I think the output gap is designed around trying to figure out where potential growth is, our single equilibrium, whereas the Biden administration isn't worried about getting us back to our single equilibrium. They're trying to boost us to a fundamentally higher one.
Megan, thank you. Megan Green of the Harvard Kennedy School, Senior Fellow. Your 10-year, 122.19. And Tom, very briefly, with a 121 handle on 10s. The lower of the session, 121. 53.
Right
yields
now,
in 7 basis points.
Yeah, yields take a breather here, a little bit higher yields, but in the tweaks of the moment, John, SPX futures negative 53, the VIX out a solid 3 big figures as well, and Dow has really deteriorated down 1.5%.
Perfect guest to discuss this with in 20 minutes' time. Mark Haefele of UBS Global Wealth Management and JP Morgan's David Stubbs.
Take a break and come
Thank
back
you,
for
Tom.
9 a.m.
I'll take a 10-minute break if that's all right. I'll take 20.
Okay.
Bonds are bid, yields are lower. Here's the state of play for our audience worldwide on radio and TV. If you are just tuning in, quite a morning, quite a way to kick off this trading week. Yields in by around about 7 basis points to 122. Your equity market is softer. We're down 53 on the S&P 500, negative 1.24%. And in the FX market, euro dollar stronger, euro weaker, euro dollar negative 0.27%, euro dollar 117.74. On radio and TV, this is Bloomberg Surveillance.
With the First Word News, I'm Leanne Gerrans. OPEC and its allies have overcome an internal split that threatened its control of the oil market. They reached an agreement to inject another 400,000 barrels of crude a day into the global economy. Saudi Arabia met the United Arab Emirates halfway in its demand for a more generous limit on output. Now, Toyota won't air TV commercials in Japan during the Summer Olympics, and its president won't attend Friday's opening ceremonies. Concerns about holding the games in the midst of the pandemic have been rising. Toyota is one of the Olympic sponsors, but last month the company said it hopes the public and athletes get a satisfactory explanation about the purpose of holding these games. Senate Majority Leader Chuck Schumer has set up 2 major tests for himself and Democrats this week. Schumer's hoping to have a first test vote on the bipartisan infrastructure bill this Wednesday. That's the same day he wants all Senate Democrats to get behind a much bigger spending bill that would carry out the bulk of President Joe Biden's agenda. Bill Ackman will buy a stake in Universal Music Group with his hedge fund rather than his blank check company. U.S. regulators looked ready to block the planned deal, citing stock exchange rules. Ackman's Pershing Square holdings will now buy 5 to 10% of the music label. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
If you aggregate up the impact of consolidation to an American household in terms of prices and wages and other attendant costs, the best estimates are that it's costing about $5,000 a year for the typical household.
Brian Deese with the Biden administration, National Economic Council Director, speaking of one Barry Ritholtz, Masters in Business, a podcast this week, a spirited conversation. We turn to the markets with the VIX up 3.25 points, negative 51 on Standard & Poor's 500 futures. Dow futures have been negative 500 for a good while here. The bond market, of course, with not an historic move, but definitely something that gets your attention. Kailey, I want to take a moment here. Kailey Leinz in for Lisa Abramowitz. And Kailey, really get to tomorrow's flight. This is radically different than what we saw with Sir Richard Branson, Jeff Bezos, rather, up in a rocket.
Yeah, and up to past the Kármán line, Tom, which is something that Richard Branson did not do. Right. Of course, the Kármán line actually what commonly delineates space. And he will be, Jeff Bezos, on the tip of a rocket, not in a plane like Richard Branson was. So this is going to look much more like your traditional rocket launch. Him, his brother, and 2 others, including an 18-year-old Tom, peaking at 18. I wonder what that feels like.
Well, it'll be interesting from 18 to 80 some years old as well. I believe it's 5 passengers. We'll have more on that tomorrow. And our team in Texas, led by Emily Chang, is just getting to Texas right now. And the weather seems to be good, at least at this moment. The weather is always good for Barry Ritholtz. He wakes up optimistic each and every day. Barry, the toughest thing to do, and you're going to do this in the real world of real money, you're going to get a call this morning from X number of people that have entrusted you with their money, and they're going to say, go to cash. What do you say?
Well, you know, the secret to dealing with clients who get nervous with a little volatility is having this conversation not when there's red on the screen, but when they actually first come to us and say, here's what I want to do with my money. Here's the history of markets. Here's how often we get a 10% drawdown, a 20% drawdown, 1%, 2%, 3% moves. There are dozens and dozens of those every year. If you go to cash every single time the market twitches 1%, you'll never be invested. And that's not what our thought process is. It's not day to day. It's decade to decade.
Well, the decade-to-decade timeline gets across the set of worries that we have this morning. One of them is a consensus call was higher yields. I believe we've gone the other way. What happens to consensus when they're wrong?
When you say when, their consensus is right most of the time when it comes to market prices. But when it comes to forecasting the economy or the stock market, consensus seems to be wrong most of the time. I can't count how many times I've been told that the bond bull market is over, that yields are done going lower. The 10-year will never drop below 2%. I mean 1.5%. I mean 1.25%. You know, the U.S. still is the cleanest shirt in the hamper of dirty laundry. And here we are, you know, we're 1-2. That's just astonishing. The people who have been betting against bonds have been on the losing side of that trade for it's almost 40 years.
What do you chalk it up to, though? As you say, we're at 121.86 right now. Why? Is that growth concerns? Is that positioning? What do you make of that?
You know, it's hard to look at the U.S. as completely separated from the rest of the world's bond markets. And we've seen negative yields in Japan for how long, and negative yields in Europe. That black hole, that gravitational pull has been exerted on the U.S. because there is so much capital sloshing around, and it's not just the Fed and QE. Money is looking for a home, and if you just want to make sure you're going to get your cash back, return of capital, not return on capital, well, who cares if it's 1%? If I put $1 billion in a bank, there's no guarantee that that bank is going to be there and give me my money back. Well, so this is a way to make sure that money that gets parked for a while is safe. And maybe it has to do with some geopolitics. Maybe it has to do with some economic concerns. But the biggest issue seems to be just an immense amount of capital, trillions of dollars sloshing around without a good place to hide.
Well, you mentioned the Fed and QE there, Barry. How high do you think the risk is of a policy mistake?
Well, every economic cycle that ends, most contractions are eventually caused by a policy. You know, I don't know if I would call it. The mistake sort of implies that if we only get this right, we can avoid recessions. Hey, eventually economies get old and vulnerable. And what wasn't a mistake in one year, suddenly the next year becomes problematic. And we tend to see bull markets killed not by old age, but by either Fed tightening that's excessive or too quick. If you believe the underlying economy is stable and strong and robust, well, sometime next year, we should start moving off of this emergency footing and slowly bring rates up. The question is, where does that become problematic for profits, and where does that become an issue for consumers who depend so much on credit? Is it 2%, 3%, 4%? That's anybody's guess. And where people get that wrong, that's your policy mistake.
Barry, thanks so much. Barry Ritholtz with us for the important Brian Deese interview as well. Really looking forward to that. Masters of Business on a podcast as well. Kailey, I look at the tape, and there's been a fractional improvement in the tape in the last couple of minutes. But Kailey, we've been free here, and I know you've got to put up with Matt Miller on a daily, hourly basis as well. Let's channel Matt Miller with Kailey Leinz, folks. How about that bit dog? I mean, Kailey, Bitcoin and the Ute of America and their certitude on Bitcoin, it's being tested this morning.
It is. I would argue it's been tested for a while, Tom. We are well off the highs that we saw just about a month, call it a month and a half ago. And it's interesting to me, Tom, for a while there was this narrative out there that Bitcoin is an inflation hedge, that this is what you do to protect your portfolio against pricing pressures. That is not something that has worked for you at all, really, as we see these hot inflation prints coming in.
I thought that the gentleman we talked to earlier on gold was collegial and gracious in his condemnation of linking Bitcoin over to gold as well. What else do you see in the terminal, Kailey Leinz?
Well, I'm watching oil. We haven't really talked a lot about it today, Tom, given the action we're seeing in the bond market. Again, a 10-year yield down about 6 basis points. But crude, too, we're down nearly 4 percentage points on WTI. And I feel like this could be because of many factors. You have a stronger dollar. You do have an OPEC plus supply deal, more oil coming onto the market. And then layer on top of that also these concerns around the Delta variant, which could, in theory, dent demand. And I think that Delta variant is kind of a broad theme that is overlaying on risk appetite today, Tom.
Halima Croft, RBC Capital Markets, says it's a sigh of relief for the Biden administration to see UAE and Saudi Arabia come together. Stay with us through the morning on radio and television. These are markets on the move. 12 noon, balance of power. Heather Boucher with the Biden administration. This is Bloomberg. Good morning.